quality, color, So is it visually stimulating to the judges? So you'll be judged based on that. The sub-regional competition, like I mentioned, once you proceed from here, the winners will move now to the EMEA sub-regional. That's Sub-Saharan Africa, Eastern Europe, Northern Europe, Southern Europe, Western Europe, Middle East, and North Africa. So the pool gets bigger. So here you're competing against 8. Next will be hundreds of universities. So imagine a sub-region of many universities from across the EMEA sub-region. So it gets tougher and tighter as you proceed. So these are the countries, for example, that you'll be competing against. So once we are done with Sub-Saharan Africa, you'll now compete against Eastern Europe. So universities from all these countries. You can imagine the competition and how stiff it is, okay? So brace yourselves. The winners for today, you need to brace yourself. That's the timeline. So once we're done here today, we'll proceed to the semifinals in April. Then after that, we'll have our regional finals, which will also be in April, a few days later. And then the global final eventually will be on 5th of May. Finally, our winners today will go home with $500. I don't see you excited or eager. $500 is a lot for, a team of 4 or 5 students. So the winners today will walk away with a check of $500. I'd like to wish you the best of luck. It's going to be a long day. It's going to be an intense day. But we'll keep you updated in case anything changes. But the best of luck to everyone. I think there's one university that has not registered. Please quickly come to my table and register. But I'd like to now usher out everyone except Team A. We are officially beginning the competition.
So first, no, don't worry. Yeah.
Experience being in the investment space. A lot of your judges are in the same space. Have a chat with them, hear them out, understand, because I'd say the key takeaway from the research challenge, in addition to the skills that you learn in terms of analysis, which I never got a chance to until when I got employed, you're getting that opportunity early on, is to grow your network and grow it with the judges. Start from there. Okay. So I wish all of you the best. Don't be too nervous. You already know the information. There's no right or wrong. Whether it's a buy or a sell, it doesn't matter. It's whether you have conviction in terms of what you're putting across and whether you can support your view strongly. So I wish you all the best. Thank you.
Thank you so much, Francis. So we'll go back to regular programming. Team A, please remain behind. They provide you with a clicker. A clicker will help you move through your slides as you're presenting. So your pace will be, all right. Team A.
That is 3 times the current stock value. Now, before I let my team members dive into this further, let me just highlight some of the reasons why you should invest in CRDB Bank. The bank has shown consistent financial growth. As of last year, the bank reported a net income of about 580. That's a 30% increase from the previous year. Additionally, the bank has shown improved financial efficiency, and the bank is also more involved now in more strategic investment and sustainable initiatives.
The journey all started in the year 1996 when CRDB Bank was established, and it is currently listed in the Dar es Salaam Stock Exchange market. It was able to successfully open 2 other companies, that is in Burundi in the year 2015 and DRC Congo in the year 2020. 26 years down the line, there's something that is worth noting is that they made a powerful executive presence of having 2 million active customers regionally. So CRDB Bank has 2 major business components, the business to business and the business to customer model. So this model is essential because it provides financial solutions that are tailored towards each client, from SMEs to corporate institutions and other clients. Now we must remember that CRDB is a business, which means it is there to generate profits. In which ways are they able to generate profits? One of them is interest income through loans and repayments. We have the fees for services such as maintenance fees. We have investment income and insurance premiums because they do have a CRBD insurance. So in achieving this clientele, they have a number of branches. They're the physical branches, the online banking system, and the mobile app. So SIM banking is very powerful because it encourages inclusivity. So they've been able to collaborate with a number of companies, one of them being IFC, in terms of providing financial solutions, rendering loans to clients. And then we also have the TMRC.
As you can see, in the financial market of Tanzania, CRDB Bank leads the financial market with a high market share of total assets, high market share of customer deposits. Additionally, in the debt market, CRDB leads the financial market with a high market share of loans and advances. Now, ladies and gentlemen, this position is even stronger in the mortgage market as they hold up to 36% of the mortgage market as of last year, 2024. And has established market dominance. Now, how has CRDB Bank been able to do this? CRDB Bank takes advantages of the opportunities such as the growth in digital services, like my colleague has mentioned, the mobile banking, and as well as they take advantage of the growing economic conditions within the state they operate. Now, let's not forget that to achieve this success, obviously there have been challenges throughout the years. Now, some of the challenges that CRDB has faced is the no unique product different from the other banks. But then CRDB aims to tackle this through their their established market dominance, because they are market leader in the financial market of Tanzania. Additionally, another threat that they've come over the years is the foreign currency volatility. Now, they aim to mitigate this risk through their robust hedging strategies, which my colleague Abby will go through them as we continue.
So under the risk matrix, as you can see on the screen, we have the credit risk being of low impact. Are you aware that CRDB Bank has non-performing loans of 2.8%? That means that the probability of defaultment are extremely low. The next one I shall be taking you through is geopolitical risk, which is high. Following the political apprehensions that are happening within DRC Congo, we see why the impact is high. Then under the liquidity risk, as much as it is high due to the evaluation of the currency, CRDB Bank has been able to come up with hedging strategies in order to mitigate this risk.
Looking at the ESG analysis, environmentally, ESG has involved itself in paper usage reduction, renewable energy sourcing, as well as water consumption reduction. Socially, they've been involved in a youth empowerment program, as well as a women empowerment program. And in terms of governance, they have a two-tier management system with a hybrid structure, and with the top management having 15 to 29 years of experience.
Moving on, we shall look at a bit of the technical analysis of their closing share prices for the past 5 years. And for this, we look at a trend analysis using the simple moving average. And one thing to note is that, as you can see on our graph there, the blue line represents the closing prices, while the red is our short-term indicator and the green is our long-term indicator. So there's been a general bullish trend over the past 5 years. And something to note is that in the second quarter of 2023, we experienced something called the golden cross, where the short-term indicator cuts the long-term indicator upwards, which indicates a prime position to enter into the market, which has been sustained over the course of the time till presently. Also, something else that will enable us to do a proper technical insight into this is the relative strength index, which enables us to see the momentum of stock price movement. And we realize that the highest ever seen was 60%, with the lowest being at 44%. And that shows that there's been price consolidation and strong investor sentiment.
Looking at the financial performance, there has been a rise in the return on equity and return on assets, and this is a reflection of effective utilization of assets and equity to generate profits for the business, as well as there has been a decrease in the non-interest expense to gross income, reflecting effective operational efficiency. Been steadily increasing, and they have been strong, and this has enabled the expansion of the business, and it has helped in the acquisition of CRDB Burundi and CRDB DR Congo. Then looking at the components of the balance sheet, there has been better management of loans and hence the better asset quality. And of importance to note is the increase in the shareholders fund, and this has been majorly because of the acquisition of the launching of CRDB Burundi and CRDB DR Congo.
Moving on to the valuation by the multiples approach, we chose the following peer companies because of their regional presence and their market capitalization, that being Equity Bank, KCB Bank, Stanbic Bank, and Absa Bank, and locally the NMB Bank. So we did an average of the price to book ratio analysis, and from the valuation approach, we found that the intrinsic share price of the CRDB Bank should have been at a value of Tanzanian shillings 1,800. Also, we looked at the residual income, which shows the worthwhileness of a project that is being run by an entity. And over the past 5 years, there has been a bit of a challenges, like during the COVID-19 and currency fluctuations due to geopolitical issues. But then this has been rectified over the course of the year by employing their hedging strategies, and we project that they will have positive residual income, which shows that this is good shareholder value creation.
Now let's assess the funds available to equity shareholders after deducting the capital expenditures. From our graph, that's the free cash flow to equity. Now from our graph, we realize that the company's free cash flow to equity has been consistent since the year 2019 to 2022, peaking at a value at around 471. Now, what does this show us about CRDB Bank? It shows good financial health and a strong cash generation.
Next is the price to earnings ratio. There has been a sharp decline from 2019 to 2021, and this could either be because the share is highly undervalued or there is risk. But for CRDB's case, it's more likely that the share is undervalued, and if you compare to the
Therefore, in conclusion, we would like to say that CRDB Bank is a bank experiencing growth on wings. They have shown consistent growth over the past 5 years with an average of 29% growth and expansion in the market. Therefore, we highly recommend that you buy, and if you have these shares, hold them. Thank you.
I have a question on, you had a slide on their income drivers. So is it in alignment to their core business, and which is the highest income driver?
Okay, I shall start off with that. So the biggest in their core business is on the banking side of it. They do have an insurance segment, but the highest has been on the banking side. That's the core driver. And one thing to notice that they have quite they have quite vast financial instruments, especially for loans and advances. Similarly, they also engage in project development, which is also something else that is really key for the CRDB Bank.
Thanks. Slides where you...
Because of the current 3.1 inflation, then we used 25% for the growth of the income. Then another thing we did is for the equity charge. For the past 5 years, they have had a cost of equity of fluctuating between 8.2% to 9%. So that's also another thing that we use to do these projections up to 2028.
I would also like that. I also like to add that the values that my colleague has just highlighted everything has been shown in the report. Thank you.
I want to ask a question that's related to this. What happened to the accounted for and adjusted for the fact that this 25% that you're using, even for the cost of equity, it's quite high if you have not adjusted for. So I wanted to know, did you adjust for that extenuating circumstance in 2020? Because it might have.
Clarify, translation losses incurred when loans are paid on spot rates.
I have another question. What is the distribution of the non-interest and interest income? I don't think I got clarity on that. Both the income side and the expense side, what is the contribution of the interest income from interest and non-interest, both for income and expenses? The actual financials.
Yeah, okay. Could you please repeat your question again?
Okay, when you're looking at the financials, we have contribution of what has made up the income and also what has made up the expenses. So I wanted to know what is the distribution between the interest income and the non-interest income, and also on the other side, interest expense and non-interest expense. What's that distribution looking like?
Okay, so I can take you through the non-interest income. So I think it's mostly they're very huge in the loan and mortgage market. So There's that, and there's customer deposits. Then for the expenses, maybe a colleague could help with that.
Allow me to take you back to our graph. If you look at our graph, the third segment of the graph. So here we have a movement for the non-interest expense to the gross income for the years beginning 2019 to 2023. So this is the movement. It's a movement schedule for this. So looking at so the purple one, that's the 2019 one. So this was the distribution of the non-interest income to gross income. So the non-interest income in 2019 was at around 65%, but then over the years that has dropped. So this was due to them also employing good credit policies to enable them to collect more on their interest income.
I have a follow-up question on the income, just also tied to the first question I had asked. Do you think that the distribution of income is in alignment with their core business as a bank?
Yes, it's in line with their core business as a bank. So I'd like to highlight two things, or let me highlight three things about the core business of the bank. So according to the Evolve strategy, there are three things that they are mainly major in, and the first one is the financial services they offer, and the second one is investment, and they're heavily in the line of the mining and agriculture. So the distribution for that was also quite high because they had a larger proportion of their income coming from those two segments. And last but not least, the third one, it's also in line with their sustainability bit of it, because they're also part of the green. They have a green fund that is also part of the World Bank program.
Thank you for that. So I have two questions. So the first one is around, you mentioned they have 2% of non-performing loans, right? I see you've done some sort of regional analysis. Can you just explain why that number, how that compares? So that's one question, why you thought that number is important. And the next question is around your valuation. It seems as significantly undervalued, right? So what are the kind of top three, if you say, drivers of the company being undervalued? Thank you.
So the non-performing loans are at 2.8%. I think that is explicitly seen even in the CRDB report. So we were able to extract that and know it's at 2.8%, which is very good for the CRDB bank because the defaultment is extremely low. Yes.
To add on that, allow me to make a comparative review of the non-performing loans. So I'll begin locally. So their closest competitors being NMB Bank. As of the financials of 2023 and then 2024, let me start with 2023. As of the financials of 2023, the NMB Bank had non-performing loans of 3.8%, and at that point, CRDB Bank was at 2.6%. Then as of the financials of last year, the non-performing loans for CRDB Bank was at 2.8%, and for the NMB Bank is still at 3.01%.
So please repeat your second question.
Sorry, the first one was around the top. I said the company, your valuation is considerably higher than what you have. So what are the kind of top three drivers of the company being undervalued as of today, and why should we buy?
One is the growth potential that they currently hold, the expansion into Zambia and Comoros.
Do you want me to repeat?
It's okay.
So expansion into Zambia and the second one is the
Okay, let me just say the first reason why I think that is so. Because one of them is because they're planning to expand into Zambia and Malawi. So that's one of the reasons. And my colleague will highlight the other reasons.
Okay, so I'll highlight one reason and then I'll pass it on to highlight another reason. So the second reason as to why this they are also highly undervalued is that there are two main programs that we had earlier highlighted, but I think maybe we should go into detail about it. So one, through their partnership with the TIB Development Bank, they are a business that is highly engaged with the government in terms of infrastructural development, which means majority of the projects within the country are actually financed and foreseen as a PPE by the CRDB Bank. Then I shall pass over to one more reason to be given.
I think another reason would be market fluctuations. So the Tanzanian currency has been fluctuating. In fact, in the first quarter in the year 2024, it depreciated to around 1.8%. So there's that undervaluation. But you see now, CRDB comes in to mitigate that because they have something called an FX hedging strategy, which helps in terms of stabilizing the currency. And that can also be a contribution to undervaluation.
Last but certainly not least, they are highly involved in the agricultural sector. And one thing to note is that in terms of the inflations, one thing to note that is very, very prime is that Tanzania had the record lowest inflation rate at 3.1% as of close of 2024. And another thing is that because they are big on the agricultural side, one thing to note is that the agricultural more of a net exporter when it comes to agricultural services, which is something that also has propagated into the Burundi market.
The key competitive edge strategies for the CRDB Bank? 3, at least.
Please come again.
Competitive edge. What makes them outperform the market? 3 key.
Allow me to start off with the first one. So one of the differentiating aspects of their strategies is that one, they are a key partner with the BOT, that's the Bank of Tanzania, and the Treasury. So they are actually the ones who So they are actually the ones who are involved with the investment side of the capital market, offering both financial literacy programs and also the CDS accounts, which means that they propagate the investment side of it. Second strategy is the digital expansion. So they look to reach the unbanked within the region, especially there's a high unbanked population within the Burundi of up to 56%. So they look to tap into that market, and I'll allow one more to be raised.
Banking. When you go to Tanzania, when you bank with other banks, the citizens usually ask for the same banking app. So I think that's one thing that has made them a major market shareholder because of the uniqueness of their product. Yeah.
Just to follow up on what my colleague has said, as CRDB Bank operates regionally, and you notice that the other competitors, most of them are operating locally. So I think that's also something that makes the bank.
Team A. Round of applause for Team A. Judges, I'd like to request that we limit our questions. We only have 5 minutes Q&A for judges, so our timekeeper will give you a 1-minute warning when you're exceeding your time. I know it's exciting to ask the questions and get the team members to answer them. But let's restrict it to 5 minutes, please. Our timekeeper will just give you a pop when it's 1 minute so that you limit the questions. We'll now be proceeding to Team B, so we'll give you maybe half a minute to Team B come on stage. Yeah.
In a good way.
Okay. No.
Okay, how does it look out? This is next. Okay. Oh, so this is back and this is front. Hii ni kwenda mbele ni kurudi nyuma.
The laptop.
Oh,
Laptop is
yeah.
there.
Oh, this is front back. Front back. Yeah. Alafu nimekaa pale ndio muangalie timings. Just there.
All right, Team B. Good luck to you. Your time starts now.
All right. Good morning, ladies and gentlemen. So, CRDB aims to provide great socio-economic value to all its stakeholders, and this is why we issue a buy recommendation at a target price of 836.1 Tanzanian shillings, which is about 42 Kenyan shillings, representing a 28.63% upside. We do believe that the CRDB stock is undervalued for three main reasons. One, strong valuation insights. When you look at the PE ratio, it currently stands at 3.21 compared to the industry average, which is at 6.5. Secondly, is the strong financial metrics. CRDB reports a high ROE of 28% and various other financial metrics, as you can see on the slides. Thirdly, is the strategic regional expansion that is currently embedded in their evolved strategy and has shown early success, particularly in Burundi, reporting a 46% profit increase. Now, CRDB is one of the largest banks in Tanzania. In terms of balance sheet size, they are number one, and in 2016, they were the first to receive a B1 Moody's rating, showing their strong financial position. They do have 4 subsidiaries. That is their branch in Burundi. Secondly is their branch in DRC, the insurance, and the foundation, showing a great presence beyond Tanzanian borders. They are also clear trendsetters in the Tanzanian market, their top contributing sector at 42%. And when we look into their major revenue contributors, we see retail and corporate banking are at their top. Taking a deep dive into the industry analysis, we're able to see that the banking and finance sector in Tanzania has grown from 2.3% to 8.6% in terms of GDP. And this just shows that Tanzania's economy is growing fast, and investors have a great chance of benefiting from higher profits in the coming days.
Let me take you through a deep dive of the investment summary. As you can see, we focused on 3 main theses, the first one being market leadership and future outlook. Now, CRDB is the largest bank in Tanzania currently, with 27% of deposits and 25% total assets, and they target a market share of 30% by 2029. As you can see the profit after tax graph, we can see the trajectory shows an aggregate growth, showing strong profitability. Coming forward to the cost to income ratio, which is currently at 49.5%, we estimate it to be at 45% by 2029, which shows great operational resilience. Additionally, we have the non-performing loan ratio, which at 2023 was at 3.99%, and by the beginning of 2024 was at 2.8%, and we expect this to go lower, which is well below the industry average, which shows great risk management and a robust government framework. On to the next thesis, we have strategic growth and regional diversification. As you can see, CRDB expects to expand into Asia, Congo, DRC, and Zambia. They expect to expand into Congo, Zambia, and Uganda, and are currently in DRC and Burundi, where they have a 6% profit after tax to the group. DRC has a joint venture investment with Norfund, where they focus on digital solutions and have a 15 to 20% CAGR expected by 2029. Coming on to Burundi, which is the largest branch as of 2024, currently with a 30.7% profit after tax growth in 2023, and targets a market share of 20% deposits and 25% total assets. Additionally, the non-funded income is currently at 35%, where they expect it to be between 35 to 40% by 2024. Finally, we look at the last thesis, which focuses on strong financial metrics and ESG leadership. Currently, the capital adequacy ratio is at 17.3%, which is well above the industry average. They also expect to be the leader in green finance, with 15 to 20% of their loan book consisting of green finance. They also have the Kijani bond, which is well oversubscribed, and they are one of the ESG leaders. My colleague will take you more on the ESG aspect of it.
The environmental, social, and governance initiatives by CRDB are part of their 5-year Evolve strategy. The future is green, and the best way to predict the future is by creating it. So what steps has CRDB taken in the past few years? From 2010 to 2014, we see CRDB take their initial steps towards sustainability. They begin to incorporate it into their operations and set up a foundation for long-term sustainability. From 2015 to 2017, they introduced the ESG criteria. They begin to introduce social and environmental impacts into their credit assessment frameworks. From 2018 to 2019, this marks the green finance era, in which they adopt the UN's SDGs. From 2020 to present, CRDB has been expanding substantially. They've developed the CRDB Foundation, as well as Tanzania's first green finance product. But what next for CRDB? Their environmental initiatives consist of a reduction in carbon emissions by 10% and water consumption by 25% by the year 2030. They also aim to cut paper usage by 20% in the year 2025, as well as make a shift into renewable energies. They also have the plan to roll out LED and sensor lights for efficient energy use across all outlets. Socially, they've been focused on gender equality. Currently, they stand at a 56 to 44 male to female ratio, but they aim for a 50-50 male to female ratio, men, small-scale farmers, as well as youth entrepreneurship. They also support healthcare through the CRDB Marathon in partnership with other healthcare centers for ease of accessibility in healthcare. They've also received and been recognized with awards for SME banking. When it comes to governance initiatives, they have established a rotational board structure, which enhances diverse and fresh perspectives. They've also got a board committee for risk management, audit, as well as compensation. They have established strong ethical standards with whistleblowing policies and stakeholder engagement channels. CRDB has consistently shown that they have been adaptable to a world inching towards sustainability.
When we take a look at the financial metrics of it all, CRDB has shown great financial strength. The revenue has grown consistently over the past 5 years, mainly driven by interest revenue with a CAGR of 20%. From this, we project that revenue will grow to 2.64 trillion by the year 2028. Moreover, CRDB's key performance indicators set it far apart from its industry peers. The non-performing loan ratio stands at 2.8%, showing the bank's strong credit risk management. The return on equity stands at 26.7%, which is significantly higher than the industry average of 21%, showing the bank's ability to return to its shareholders. From our cost analysis, CRDB has made remarkable improvements. The cost-to-income ratio stands at 49.5%, which is well within the bank's benchmark of 50% and lower than the industry average of 51.6%. This trend is in line with the bank's goal of achieving a cost-to-income industry minimum requirement of 20%.
Ladies and gentlemen, at the beginning of our presentation, we issued a buy recommendation, and our critical question is why. Allow me to take you through the valuation methods to explain and reinforce our position. Firstly, we did a 5-year DDM model using a cost of equity as shown and a growth rate that aligns with Tanzania's GDP growth rate. This resulted in a share price that's at 25% upside from the current market price, reinforcing our buy recommendation. We also did a residual income model using a weighted average cost of capital of 13.77% and a cost of equity and a growth rate that are consistent with the DDM model. This resulted to a share price that are 41.6% upside, supporting our buy recommendation. Lastly, we did a Monte Carlo simulation, and this gave us a probability analysis of a probability price range of 660 to 750. The reason why we chose these valuation models is because they allow us to flex the macroeconomic assumptions of Tanzania. We also did a sensitivity analysis to provide further insight of a conservative scenario and an optimistic scenario. However, we maintain a positive outlook because of Tanzania's positive growth economy rate. Hence, we expect the price to be between the base case scenario and the optimistic scenario. Lastly, I will take you through the investment risks that are associated with our recommendation. First, we have CRDB's high reliance on debt financing. However, for this, they have implemented cheaper financing such as the Kijani bond, which allows them to mitigate that. Second, we have economic and political risks, especially in the subsidiaries in Burundi and DRC specifically, and they mitigate this using country-specific risks. We also have the impact of climate change, which mostly affects the loan portfolios in the agricultural sector. However, they have capacity building sessions to educate the stakeholders involved in order to mitigate this. And lastly, we have security threats that are mitigated by advanced security technologies. We also did...
Going to communicate effectively with the customers, then what advantages do they have that they can exploit to achieve this growth?
So CRDB focuses on diversity. So we believe that they deal more with the people who are already there in DRC. So as they establish the branch, they're already working with the citizens who are there. Now, on the second question, you asked about what. Could you repeat the second part of the question, actually?
What advantage do they have? Because everybody's heading there. So how are they going to outcompete other banks?
I believe it's the strategies they use. Because number one, CRDB is focusing on targeting the unbanked locations within those areas and then improving the digital solutions. So like take Burundi. They've been in Burundi since 2012 and now it's one of their most profitable branches. So I believe the people there already have a good connection with the CRDB. And with DRC, it's fairly new, but they aim to target, again, the population that isn't banked by the current banks that are there. That way targeting a niche, a market that has not been explored.
I saw your valuation methods. What informed your weighting of the methods that you used?
Okay, for the dividend discount model, what informed our weighting was CRDB's consistent history in paying dividends, and also it allows us to flex the assumptions that go into the model just for accuracy. And then investors highly value the dividends that they get from an investment, so that is why we gave it a higher rating. And then for the residual income model, we gave it a weighting of 30% because it captures the book value of CRDB, and also it captures the economic profitability of the bank. And then for the Monte Carlo simulation, we gave it a lower weighting because it mostly supports the DDM model and the residual income model, and it captures the uncertainty that is there with the first two models.
So using relative valuation methods, how would you put in price to equity as a valuation metric to assess this bank?
How we would include price to equity?
Yes, how would you use PE as a method to make your assessment?
I would say that the PE ratio would basically show us whether the stock is undervalued. And when I started my presentation, I did say that the PE ratio currently is a 3.21. And this inferred us to actually think that to believe that the stock is undervalued. So based on the metric, that's how I would use it to infer that CRDB is undervalued at the moment.
Maybe I can just tie to that. What's the market PE ratio compared to the current one that you have?
6.5.
Okay. I wanted to find out something just clarity-wise. You had mentioned that there was a 20% CAGR in the DRC-related business, and I was curious, is it related to the bank's bottom line with regards to DRC alone, or is it regarding the Northern thing, or is it separate? Is it the whole bottom line of the whole business?
We believe that it's due to the whole business because they are investing within DRC. At the moment, profits have not been realized, but they have assets, and that's why they believe that within the next 5 years, they can be able to realize that CAGR.
Thank you.
Thank you too.
Thank you.
Thank you, Team B. We shall now have Team C come up on stage.
No. Yeah, flashlight.
Welcome, Team C. All the best. So we'll give the judges about 30 seconds to complete their scoring for Team B. And then Team C, you can proceed. You can use your pointer to go through your slides, forward and backward. All right. Team C, the stage is yours.
Good morning, esteemed judges, distinguished guests, and fellow participants.
Microphone.
Once again, good morning. Good morning, esteemed judges, distinguished guests, and fellow participants. My name is Nicholas Mlama, and together with Team C, Janet Akinyi, Esther Wambui, and Benson Kimani, we are going to do our analysis of CRDB Bank, a leading financial institution in Tanzania. Our analysis strongly supports buy recommendation for new investors with a 36.8% upside. For existing shareholders, we recommend they hold their stock for CRDB as ongoing growth initiatives. A brief history about the bank. CRDB was established in 1996, and it transitioned from a government institution to the leading financial institution in Tanzania. The bank has also been recognized as the best bank in Tanzania, leading in customer experience and digital innovation. Moving forward to company overview and financial analysis, the bank commands a 27% market share in the banking sector in Tanzania, and it also has non-injury. The bank has also prioritized climate-friendly projects and community development. Some of the challenges and opportunities that the bank faces include high operational costs, market undervaluation, and regulatory compliance challenges. CRDB has also ventured into underbanked regions, e.g. the DRC, and it has also invested in diversified and it has also, the bank has also invested in, has done product diversification and digital transformation. CRDB is not just a bank, it's a driver for regional economic growth, and It's a driver for regional economic.
Income has been, total operating income has been increasing over the past years with the net interest income at 20% for 3 years CAGR. What about the total net non-interest income as a percentage of operating income has also contributed to 27% of the total income, showing how the bank has well diversified to other income sources. And in terms of expenses, it declined from 82% in 2018 to 52% in 2023, showing how the bank is cost efficient while managing its other activities. What about in terms of asset utilization, the return on asset climbed from 1.1% to 3.2%, that is from 2018 to 2023, and the return on equity was pinned at 23.7%. You can move on. Yeah. Okay. In terms of the liquidity was maintained above the industry levels, showing how the bank can well meet its short-term obligation. And in terms of the shareholders' value, the shareholders' value climbed from 8 Tanzanian shillings to 50 Tanzanian shillings. That was from 2018 to 2023. Looking at the productivity and efficiency metrics, you can see how they have been increasing over the past years, and this was driven by technological advancement and market expansion of the bank. The net promoter score was above 91% also, and the retention was above 97%. This shows how the working environment of the company is conducive while maintaining its stability. What about the future outlook of the bank? In terms of future, the loans and advances are expected to increase by 15.1% in 2024 and 19.1% in 2025, considering 2025 is an election year. In terms of expense management, it is expected to be maintained below 45%, showing how the bank is cost efficient while boosting its profitability. Oh, thank you. Oh, in terms of the bank also expects to maintain the retention above 97%, yeah, and the net promoter score above 91% as it has been in the past. Looking at the history and financial analysis of the bank, we can clearly indicate and show how the bank has evolved to be one of the leading financial institutions in Eastern Africa. And thus, don't forget our buy recommendation. I'll welcome my colleague to continue.
Thank you. My name is Esther. I will take you through the valuation bits. First off, we have the DDM model. Our group focused on 3 kinds of analysis, which are under the fundamental analysis. We also did the technical analysis, but for now we'll focus on the fundamental analysis. First off, we have our DDM model. In this model, we use this model as proposed by Gordon, since the bank pays out 35% of its earnings towards dividends. In this model, yes, that one. In this model, you had to make critical assumptions, including that growth rate is a component of dividend payout ratio, ROE, as well as historical performance, and IMF projections. In this model, future dividends are discounted back to its present value, so as to get the value of a stock. With the assumptions in play, as well as other assumptions that are on the slide, we had a value per share of 638 Tanzanian shillings, which is higher than the current market price of 555 Tanzanian shillings, which shows that the share is undervalued. To confirm the findings of this model, we went ahead to do the DCF model, where in this model, future cash flows are discounted back to its present value, so as to get the value of a stock. The assumptions are detailed on the slide above, and I may mention one as a way of passing. We had assumptions like the 2025 elections, the inflation, and at base case, we had a value per share of 842. At worst case, the value of 703, and at best case, the value of 989, which shows that the share is undervalued. We went ahead to do the relative valuation model, where metrics are picked and an entity is compared with its peers. In this model, in this type of valuation, we used 6 metrics 6 ratios, including price to book, price to earnings, and DYR, as well as other ratios that are detailed on the slide. We also compared CRDB Bank with its peers, which are listed in the Dar es Salaam Stock Exchange market. And at price to earnings, we had a value of 996 Tanzanian shillings. At DYR, we had a value of 1585 Tanzanian shillings. And at price to book, we had a value of 778, which cemented our recommendation to buy or hold the stock since the share is undervalued. And for the investors, we do not give you a lap of luxury since we also have the risks concerned with so as to get these values. And I'll welcome my colleague to talk about it. Thank you.
Okay, thank you, ladies and gentlemen. My name is Benson Kimani, and I'll be taking you through risk analysis. And CRDB bank risk can be categorized into various types of risk, namely operational risk. We have financial risk, regulatory risk, as well as macroeconomic risk. And we'll start with the operational risk. And operational risk is the risk that is associated with the day-to-day activities of the bank. And this risk is it's that average when it comes to the magnitude, and it can be controlled through robust investment in infrastructure as well as technology that help in operational efficiency. Secondly, we look at regulatory risk, and under regulatory risk, we were able to evaluate credit risk as well as financial or foreign exchange risk. And the magnitude of this risk is at average, and it can be controlled through diversification of loan portfolios as well as hedging against various currency risks. Next, we look at the macroeconomic risk, and in the macroeconomic risk, we were able to evaluate economic slowdowns as well as global commodity prices. This can be maintained through maintaining prudent risk assessment during lending, and also financial risk or regulatory risk. And under regulatory risk, we were able to look at various types of risk, and it is at average, and we can be able to control it through close alignment with government policies. Thank you, ladies and gentlemen. Thank you.
I think you have been caught up with time, but had you captured the ESG aspect of the presentation briefly? Please tell us about it.
So for ESG, we talked about sustainability, and the bank is investing in SMEs, climate-friendly projects, and also engaging in community development. Whatever I've not mentioned, maybe my teammate can add on it.
Just to add on what he said, the bank focuses on environmental factors where it ensured that 27,000 an approximation of 27,000 kilograms of solid waste had been recycled. And also it invested in women-led enterprises as well as youth, which an example is the Malkia account. It also invested in the governance side of ESG, where it ensured that the reporting principles are according to the ESG standards. Thank you.
Everyone.
Hello.
There's a slide you had that was talking about the capital adequacy ratios, and they were all declining for the projections you had. So I wanted you guys to help me reconcile that with the fact that you've based one of your key drivers for the business succeeding on the fact that they're reducing their NPL loans. It's reduced from to 2.8, right? But your projections are showing that NPL loans are going to increase. So maybe you can just clarify that.
So when it comes to the non-performing loan interest, we look at the bank is putting up credit risk assessment structures to ensure that the people who are lending or who are being lent the loans are able to pay. And so that is one of the things that will make it to grow in the future, since the bank is already putting up the measures to ensure that it has done prudent risk assessment when it comes to lending. And so when it comes to the risk of default, it goes down. since the structures or the measures has already being already put in place.
So you modeled for those non-performing loans increasing actually.
Yes.
To check your numbers. Something to note maybe, yeah.
So on one of the slides you mentioned that one of the challenges the bank experiences since it's in multiple jurisdictions is that they have a challenge in adapting to financial regulations. So I think, the financial industry is built on a lot of trust. So what are the mitigants or the workarounds they are having for this? Because I think investors would need to trust that the bank is in alignment with the governance structure in the country.
Thank you for your question. The bank is ensuring that they have a conservative growth outlook so as not to mislead the investors. Thank you.
Also, to add on to that, we can say that the bank is keeping a close alignment with the government policies to ensure that they are up to date with the new regulations and policies that come out. So they keep close alignment with the various policies, various organs that make these policies. For example, the government, that is. Yeah.
Okay, let me ask one quick question. Everyone is talking about cost reduction being a key thing. What for you in your group is the key drivers that are leading to this cost reduction that is actually increasing the bottom line?
Okay, thank you for the question. As you can see, the return on assets, of course, has been below the industry average due to the bank is working on increasing their asset base. Looking at the non-interest income as a percentage of operating income, of course, it has been declining from 80% to 52% over the past years, and this has been due to technological advancement. What about the technology advancement? The company focuses on improving on mobile banking solution, which will of course reduce the operation cost and other transaction costs for the customers and also for the banks, increasing customer engagement to the bank. Yeah. So I think that one will, it will continue over the time because they are still focusing on advancing on technology. Yeah.
Did you consider the price to book as a valuation method?
Yes, we did.
Should I clarify the price to book? Okay.
It's okay. Okay, so thank you.
Thank you so much. Round of applause for team C, D. Judges will give you 30 seconds to complete your scoring as we welcome Team D on stage.
all protocols observed. I'm Titus, representing team. I'm Titus. We are team D, and here are my team members to introduce themselves.
Hi, I'm Roti Boniface.
Hi, I'm Cynthia Mwende.
Good morning, I'm Lynette Mora. Okay, our presentation outline will be, we shall begin with the executive summary, then we move to company background, where we shall talk about the company profile and the company SWOT analysis. Number 3, we have the ESGs, and we will move to company financial analysis, where we shall talk about the investment outlook and peer analysis. We shall finish with the company valuation, where we shall talk about valuation concerns and risk outlook. The executive summary, cooperative the bank was founded in 1996 and has been in operation for over 28 years. It also has branches in Burundi, which started 12 years ago. It has another branch in DRC, which began in July 2023. CRDB has over 4,000 staff with 12 board members with 18 years plus of experience. The future outlook of the bank seems promising, as the evaluation dated 16 December 2024, the target price was at 660. Our book value was at 456.52. We recommended a buy because the shares were undervalued.
So, under company profile, we have CRDB was the first local bank to introduce debit cards in 2002, the first bank to also introduce mobile banking in 2011, and the first bank to introduce agency banking in 2013. It offers corporate banking, retail banking, and also microfinance banking. Corporate banking, it offers services to large corporations, whereby it offers loans and trade finance. Then under retail, it offers services like loans and savings account. And microfinance, it offers services to small, medium enterprises. And then we move on to the SWOT analysis, where we have threat of new entrants. So here, basically, fintech companies and microfinance institutions offering niche services could enter the market with lower overhead costs. So this is whereby this will be a threat to the company, since it will have a better, the ones that enter with low overhead costs will have a better competitive position. And the bargaining power of customers, increased transparency in the digital platforms enables customers to compare interest rates, let's say when they want to take loans, and they can decide on which bank to borrow from. And then under number 3, we have bargaining power of suppliers. So this one basically, like, the central bank regulates banks. So let's say when they change their interest rates, this might impact the banks, making them to also, if they increase, which might make their customer base to decrease if they increase the rates they charge. And then threat of substitutes. So this is whereby mobile platforms like M-Pesa, Airtel Money, which basically offer the same services like banks, could pose threats to existing banks like CRDB. Yeah, and also microfinance institutions like SACCOs may offer maybe loans at lower costs. So, and then under industry rivalry, we have other banks like NMB, which are performing better than the others. Next, we move to ESG, environmental. Then we start under environmental. We have CRDB issued a Kijani bond, which was oversubscribed by 400%. We have water management practices and waste management practices. Under social, we have like examination leave, youth and women empowerment, religious banking for the Islamic. And then under governance, we have board diversity, succession planning, anti-corruption, and whistleblowing. Then under investment outlook, we have return on assets. So the credit rating for CRDB was B1, but there's a stable outlook for B stable. And then the return on assets, it's increased from, in 2023 it was 6.1%, but it decreased to 5.6%, which was as a result of increase of assets. Then performance by income, the net margin decreased from 42.8 in 2023 to 34.7 because the expenses were higher than the income which was generated. And then performance by equity and debt, we have the assets to equity increased from 2023 to 2024 from 7.46 to 7.73 because the company used debt finance. And then the debt to equity increased from 6.46 to 6.73 because it acquired new loans. And then the credit rating, CRDB, the rating was B1, which was actually better than KCB, which had a rating of B2. And then the market price, it has been rising since from 2022 to 2024, where it was at 456.56. So valuation, talked about it. Basically, we issued a buy recommendation because the shares were undervalued. Yeah, and the investment risk, we have the risk number one, the cybersecurity, which is basically because they use digital platforms may pose cybersecurity attacks, and in order to mitigate this, CRDB has put in place cyber security systems to fight this. Then we have fraud and financial crime. To mitigate this, CRDB has put anti-money laundering systems, and then human error, which may come from maybe the staff doing misappropriating transactions. And to mitigate this, it has digitalized most of the transactions and the processes. And then regulatory compliance. CRDB ensures it follows the regulatory put in place and also checks for any new changes. So, yeah. And the return on investment policy of 35% should be, as well as CRDB was to enter into Basel 1 or 2 in 2025, should be checked in caution. And also recently DRC, there have been political risks which could impact the market, so also that should be checked. Thank you.
Thank Thanks for the presentation. How did you come up with your valuation?
We came up with a valuation on the interest rate and loan growth rate performance at the deposition of capital in the CRDB.
Let me maybe clarify that question. What's the mix of valuation models that you have incorporated, and if you're answering that, the weighting as well that you've given those different valuation models?
So we calculated like return on income, on equity, return on income, and we also calculated using the discounted dividend model.
Okay, given the fact that CRDB looks promising, could you kindly highlight on one initiative that it's taking to ensure the underserved markets are also catered for?
CRDB has introduced the mobile banking automated telling machine for people in rural where they cannot access the banking services, so that they can access whenever they are, either in rural or the urban areas.
To add on what he has said, the CRDB also has agency banking, which has helped the bank to improve its sustainability.
The competitive analysis on the 5 Porter's forces, from my look, I've seen they're all unfavorable. Which one of them is favorable to CRDB Bank? If you can clarify.
It is, I put it on Porter's. The favorable one was, I think, Mikana.
Around your recommendation, I think we had 3 categories of buy, hold, and sell. Why not sell? Because I think things are chilling. There's the kind of upside potential for people. So I'm just challenging your recommendation. Why not sell?
We recommended that the shares to be bought because from the rights issue that the CRDB Bank issued in the year 2024, and the target price was at 660. So we recommended investors to buy the shares because they were undervalued from the calculations we did.
Kindly go back to the slide on the valuation and the recommendation. So from the slide, you can just maybe elaborate on the recommendation.
Okay. The current valuation as at mid-December 2024, that's the fourth quarter, and the 16th of 2024 December, the target price was at 660. So the Industry Financial Service Bank, which is the current price, was at 650, which is slightly lower than the target price. So there was no percentage change. The book value, we calculated the book value, so it was at 456. It was ranging there. So they had targeted their book value to be at around 460. So from our calculations, we found out that the book value was at 456.52, which is slightly lower than the expectation. So the shares were undervalued. That is why we issued the valuation.
Let me ask one last question since time is over. You mentioned about the fact that they have the best credit rating in B1. I wanted to understand, did you analyze what that rating has been in prior years? Is it stagnant? Is it declining? Has it been improving? What is the relativity of it compared to prior years?
So when we were analyzing in 2024, it was actually better, and they were downgraded to a B stable last year, 2024. Thanks.
Applause for Team D. We'd like to take a 15-minute break. Judges, we have some breakfast for you. If you don't mind just walking to the food area, serving a plate, and then going back to your seats, because it's a quick 15-minute break so that we have the next 4 teams. Bridget, you could call the other team members to come and serve their meals and then walk out with their breakfast. 15 minutes. Team E, you can start.
Dear guests and jury members, this is Team E. I'm Alfred, Sharon, Gabriel, and Nakut. And we are presenting to you our equity report on CRDB Bank PLC, a sustainability partner in East Africa. We initiate a buy recommendation based on a 1-year target price of 840.05 Tanzanian shillings. This represents a 23.5% upside from the last close of 680 Tanzanian shillings on 15th November 2024. The rationale for this buy recommendation is backed by the following 3 investment propositions. 1, CRDB is a market leader with a robust business model and economies of scale. Number 2, CRDB has shown robust financial performance and return prospects reflected in its year-over-year growth in return on equity and return on assets. Number 3, CRDB has accelerated sustainability and ESG incorporation, which an indicator has been its oversubscription of the Kijani Green Bond by 429.6%.
CRDB Bank was founded in 1996 and is headquartered in Tanzania, Dar es Salaam, Tanzania, with regional presence in Burundi and the DRC. Its core services include retail banking, SME banking, insurance brokerage, and corporate banking. On the CRDB Bank has sustainable partnership, and it has won several awards due to its efforts. On the employee sector, it has a well gender diversified workers of 46% ladies and 54% representing men. On the industry and competitive positioning, the Tanzanian banking sector has grown with 17.3%, and CRDB Bank has dominated a 15.7% market share, which shows an advantage for its growth.
Now let's highlight the key insights from our financial analysis of CRDB and its potential growth trajectory. First, let's look at profitability. Over the past 5 years, CRDB has had a consistent growth income and a strong return on average equity and assets. Both interest and non-interest income have also contributed positively. On liquidity front, CRDB has positioned itself as a market leader in Tanzania with an impressive year-over-year growth in customer deposits. Notably, 78.54% of its funding comes from these deposits, alongside its strategic investment in treasury bonds. A statement of its strong position is a massive 429.6% of a subscription in Kijani treasury bonds and international recognition, including GCF accreditation. Forward-looking, CRDB is leveraging on use of digital transformation, including innovation in internet banking, ATM network, SIM banking, and NGC partnership. With those investments, the bank is projected to maintain its dominance and strong shareholder returns. Finally, CRDB has had a robust CAMEL rating, an indication of a strong and effective leadership. Finally, CRDB is a forward-looking and a market leader positioned to its strategic partner.
With its current presence in Burundi and DRC, CRDB is focusing on expanding its market, especially in the Eastern Sub-Saharan market, and also internationally, especially with targeting on Asia. We obtain a target price of 840.05 Tanzanian shillings based on the dividend discount model and comparables valuation, which were assigned equal weights to reflect both financial strength and market positioning. The team concluded that CRDB reflects a stable and predictable dividend payout. Therefore, based on a cost of equity of 11.22% and a projected regional growth rate of 5.7%, we obtain an intrinsic value of 861.68 Tanzanian shillings using the dividend discount model. Going to the corporate governance analysis of CRDB. CRDB has shown significant challenges, especially in the board diversity and independence, which may impact decision making. Furthermore, it has shown moderate protection of shareholder rights, but which is not exceptional. Although CRDB reflects somehow a strong corporate governance and executive leadership, there's still room for improvement on its strategic policies.
Moving to ESG initiatives, CRDB has shown some remarkable observation. Starting with environmental, CRDB is driving climate resilience through green projects such as the oversubscribed Kijani Green Bond with green asset ratio target of 30% by 2030. CRDB also has recycled 27,824 kilograms of waste since 2001. Socially, CRDB has shown financial inclusion through Islamic banking alongside investments such as health, education, entrepreneurship to women and youth. Third, we have governance. CRDB principles are embedded in operations led by a diverse and experienced team. The board members consist of 83% Tanzanians, 17% women, all with 18 plus years experience. Finally, we have CRDB leadership. CRDB leadership has shown credibility and experience led by Managing Director and CEO Abdulmajid Sekele since 2018. A seasonal leader with expertise in corporate and retail banking. He's also been, CRDB leadership also consists of the chairman, who is Leil. Thank you.
Okay, during our analysis, we identified two most significant risks that are worth highlighting. First of all, as earlier demystified, in the revenue segmentation of CRDB, it generates a substantial amount of its revenue from SME banking, and therefore it's exposed to probably high non-performing loans due to sectoral exposure to agriculture and SME. The rationale for this is that the SME sector is very volatile to macroeconomic shocks, and also the agricultural sector is very volatile to climate change. So on its diversification strategy, especially on its most significant risks, CRDB has aggressively diversified its revenue segmentation and also its distribution channels, both physically and through online presence. Furthermore, its strategic partnership with the Green Climate Fund has enabled it to provide sustainable financing, especially to its agricultural clients, and also educating them on climate-sensitive agricultural practices. Therefore, in conclusion, our analysis depicts CRBD as a financially stable and with very promising return prospects, and therefore, based on our 3-point investment proposition, we therefore like to reiterate our buy recommendation. Thank you, and we welcome any questions.
Let me start with one question first. You have used price to book only in your comparative analysis, and I wanted to understand what informed you to only use price to book and not combine it with something else like price to equity, for example, or enterprise value. Maybe you could take me through that process of the comparable part.
Okay. The comparable part, the reason we used the price to book value, I think first of all is, I can say due to the availability of information. I think, accessing most of the information for CRDB, especially for some of its information is not publicly available, so that makes it somehow challenging. But the price to book value, that one we try to obtain such information. But we breached that weaknesses with the dividend discount model, which we think that our assumptions and comparing to CRBD, they're somehow interrelating, because the dividend payout of CRBD is somehow more stable. Yeah.
Just a follow up on that. Did you consider the price to earnings multiple?
Okay, that one we didn't consider that because of the availability of information, so we used the price to book value.
Okay. In your earlier slides, you had one about the growth in the net interest margin. Could you tell us about what has driven that and what you expect going forward?
Okay, that one, on that point on the net interest margin, first of all, reflecting on CRDB's past financial statements, there is a positive income generation. Also, in the past 5 years, we used from 2019 to 2023, there's been a year-over-year growth in its net interest margin, and which is also projected in the future. Therefore, we also expect the net interest margin of CRDB to continue growing in the recent years. The rationale being positive cash flows from the past financial statement and also positive in the projected financial statements.
You haven't answered me. Is the net interest margin expanding because they're able to lend at a costlier interest rate, or have they been able to manage the cost of their funds?
Okay, the net interest margin from analysis, first of all, has expanded due to its broad customer reach. It dominates in terms of market deposits. Most importantly, the CRDB leadership, especially the chief financial officer, has the bank majorly focuses on cost optimization. Therefore, I can say its growth in the net interest margin has majorly come from cost cutting or reducing of costs. Probably in the business overview of CRDB, we indicated that almost 97% of its total transaction is done through, outside the branches. Therefore, this extent of digitizations has enabled CRDB to cut on its costs and therefore, improving on its net income margin generation.
Let me ask another question also related to percentages. I think it was one of your first slides. You had indicated that the industry growth for banking in Tanzania is 7.3%. And I wanted to know how much of this industry growth is being attributed to CRDB, if you have those numbers.
Okay, first of all, the 7.3% growth is for the overall sector, or the banking sector of Tanzania. So I think, according to our analysis, CRDB's growth is approximated to be growing at a rate of almost 6%.
I think I'm asking, this 7.3% growth rate for the whole industry, how much of it can be attributed to CRDB as opposed to other banks?
Or as opposed to other banks?
Yes.
Okay, I think being the leader of the Tanzanian banking sector, I think CRDB contributes a fairly large percentage of this growth due to its financial inclusion initiative. The Bank of Tanzania, has provided, an enabling environment for those banks that, want to be financially inclusive and, what we call the banking the unbanked. So Tanzania has a proportional share of an unbanked population, and therefore CRDB focuses on banking the unbanked population.
Just to clarify, which model did you use to come up with the target price?
We used two models. Number one, we used a comparison valuation where we compared using those price-to-book ratios. And the second one, we used dividend discount model where we got values approximately to 800 shillings, Tanzanian shillings. Thank you.
To add on that, the two models, the DDM and the comparables valuations, were assigned equal weights of 50% each to reflect both financial strength and market positioning, because as we earlier indicated, one of the risks of CRBD is competitive pressure from the industry top guns. You can see the Tanzanian banking sector is very highly competitive between the top four banks, the top banks. And some of the data can be, 77% of the total assets are dominated by the top banks. Therefore, to reflect the competitive environment of the Tanzanian banking sector, we issued a percentage of 50% weight to both the DDM and the comparables valuation to reflect both market positioning and financial strength that CRDB has shown.
Could you summarize in 3 points what are the key competitive strategies? What are they doing different than the other banks to make it give a buy recommendation?
I will say number one is digital transformation, and another one is where they are focused on small and medium-sized enterprises, where they want to include everyone, including those small companies which cannot get finances from big companies, which offer high interest rates on their loans.
So in addition to that, during introduction of presentation, I presented CRDB as a sustainability partner in East Africa. The issue of climate change has become very sensitive, and CRDB has shown a very good initiative in accelerating sustainability and ESG in cooperation in the core of of its activities. Therefore, the issue of the Kijani Green Bond has shown a very good focus on sustainability. The funds that have been raised from the Kijani Green Bond, approximately 170 billion Tanzanian shillings, have been focused on renewable energy products and climate-sensitive sustainability. So sustainability has been embedded in the core operations of CRDB, and that makes it stand out as one of the good investment prospects in Tanzania, also in East Africa. Also being a GCF accredited institution, that's a plus for you.
Okay, thank you for your presentation.
Thank you.
Round of applause for Team E. Next, we'll have Team F up on stage. Team F, you can start.
Good afternoon, esteemed judges, ladies and gentlemen. My name is Rosemary, she's Priscilla, Brenna, and Sam. And we recommend a sell with a downside of 14%, with our target price as 564.4, with our 1 month volume weight average price as 658.93, and the last close as of 2nd December 2023 is 660. And as you can see, the price equity ratio of CRDB is 2.8, and the peers was 5.3. It shows a good performance, but it doesn't necessarily mean good performance. And then from our target price, CRDB is trading above its fair value. And our target price, as I said, is 564.4. And we advise the investors to trade with caution. We are mostly focused on short-term investors.
On to the next, we will move to the business description. Okay, so CRDB is known for offering financial services such as personal banking, business banking, and digital banking. And it offers retail banking, corporate banking, investment banking, and microfinance.
We move to business strategy. So CRDB's business strategy revolves around 4 core pillars: expansion, sustainability, innovation, and customer centricity. On expansion, CRDB has expanded its operations beyond Tanzania into countries like Burundi and Democratic Republic of Congo, with future plans to enter into Kenya, Uganda, Rwanda, Zambia, and Malawi. On sustainability, CRDB has incorporated its ESG factors into its operations. The launch of Kijani Bond, aimed at funding green and sustainable projects, highlights its commitment to responsible banking. Next, on innovation, so CRDB continues to invest in digital transformation through services such as mobile banking, CRDB Mobi, and the AI-driven customer service through the chatbot called L. It helps in efficiency and customer experience. Finally, on customer centricity, CRDB focuses on customer satisfaction through offering their services in Kiswahili and English, which helps the bank to able to reach a wide diversification of its customers' demographics. Yeah, next on competitive positioning. When it comes to competitive positioning, CRDB stands out in very many ways. In its strengths, it's the largest bank in Tanzania with a 42% market share on the economic sector. It has a robust branch network, innovative financial products, and strong financial performance. On its weaknesses, it has a high foreign currency exposure, which makes it vulnerable to exchange rate fluctuations, and also its heavy dependence on the Tanzanian economic sector limits its diversification opportunities. When you come to its opportunities, the East Africa becoming a growing industrial place helps CRDB to be able to expand and deeper market penetration, and also CRDB's partnership with Citi and DFC, it also enhances its market position. Finally, on the threats, we have increased competition from both local and external banks like Equity Bank, and also regulatory changes which can also create operational changes and increased compliance costs.
I'll walk us through the financial analysis, and majorly we will check the financial ratios too, the profitability analysis. On this, we checked our return on equity, which was 24%, and this basically means the bank, it efficiently generates profit. It's an attractive option to new investors. And then our return on assets was 3.4%, which means as much as the bank is profitable, it also has room for improvement in the industry. The net profit margin was 35%, and that means for every shilling, there's a 35% of revenue that comes back, and that is purely profit. And we have the operating margin, which is 50%, and that means that is the profit they get from all the operations, and their net interest margin is 6.5%. And that means they effectively earn from all the lending they do, and from the lending they do, that brings a strong revenue generation. On the liquidity, their current ratio is below 1, which means they have more short-term liabilities than they have more short-term assets. The loan-to-deposit ratio is 95%, which means nearly all their deposits are used for lending, and they maximize their profits and reduce liquidity reserves and as they increase. Their non-performing loan rate is 3.5%, which means it's lower than the average for the industry, which is 5 to 7% normally in the industry.
So next is the ESG. CRDB takes ESG seriously by integrating sustainability in its business models. From an environmental perspective, we find that CRDB has a set goal of achieving 40% efficiency improvement by 2026. It's already achieved reductions in energy consumption by 21%, 27% in water, and 28% in carbon footprint in materials. On the social front, CRDB promotes diversity and inclusion. While executive positions consist of 25% female, there's room for improvement. The bank also supports charitable donations through the Sadaka account and collaborates with strategic partners for green project financing. In terms of governance, we do have that CRDB is accredited by the United Nations Green Climate Fund, making it the first bank in Eastern and Central Africa to achieve this recognition. To conclude, CRDB Bank ESG efforts not only drive sustainability, but also enhance its reputation and appeal to social responsible investors.
We move on to the investment summary of the bank. About expansion of the bank, we have seen it is in DRC and Burundi for the past years. About the diversification, you have talked about the chatbot L that helps in language barriers. For performance and growth, we have seen that CRDB has a growth rate of 12.8% over 10 years. So it has shown a significant growth among the banks in Tanzania. And finally, the regulatory changes
this affects mostly the other countries, which is DRC Congo, through the issues of mining and the Finance Act that has been changed.
We'll do the valuations. We chose to do DCF, discounted cash flows, dividend discounting model, and EPS. And for our discounted cash flow, our WACC was 26%, growth was 17%, and our cost of equity was 33%, derived from our CAPM. And our debt was 5%, and the tax rate was 30%. And we got intrinsic value of 860.2 per share, which shows it's overvalued, undervalued, sorry. And then we did, for dividends discounted model, we chose to exclude payment for dividends in 2020, hence giving us an intrinsic value of 539.3. And then our EPS gave us 521.8, and we chose the weights as 50%, 40%, for DDM for 50%, for EPS 40%, and for DCF 10%, giving us a target price of 564.4 with a discounted of 14%.
Finally, we are going to move to the risks and mitigations. The risks include supply chain disruption, cybersecurity attacks, and regulatory compliances. And the mitigations include diversifying supply chain and adhering to the privacies, and also using legal and legal compliances to ensure everything is working well. So, ladies and gentlemen, our esteemed judges, that has been our presentation. Thank you for listening, and we welcome any questions regarding the presentation. Thank you.
Yes, hi. Thank you for your presentation. My question is mainly around, I guess, this Kijani bond and how described as a key part of, I guess, the company's strategy going forward. Are there any indications of another round of this bond being issued once the current one matures? Are there any plans around that, given how oversubscribed it is?
Pardon? The last point.
No, I think I'm just asking around, does the company plan to do similar bonds like the Kijani bond, given how successful it has been?
Let's say currently they are working on the Kijani bond, since it is used to fund sustainable and green projects. But maybe later on, when they have expanded into the countries I had mentioned, Kenya, Rwanda, Uganda, yeah, they might opt in to authorize other bonds so that it may help in their governance in such countries.
To add to my colleague, one thing about Kijani bond is that if you want to invest, you can buy shares in the Dar es Salaam Stock Exchange. Yeah.
Thank you.
Let me just ask, because it's related to the Kijani bond. Do you have information on like the life cycle of this bond, the interest that it is paying, things like that? Because if it's one of the reasons why you're factoring it into the valuation, then it has to have that sustainability view. So what is the life cycle of this Kijani bond? Can you give us more insight on this Kijani bond? Yeah.
We didn't factor it in our valuation, but in our PowerPoint, we did show the interest, which is at 10.38, which is the second highest as you compare to Tanga. So I think the Kijani bond is doing really well, since it actually was able to enter the market in 2023 as of August.
Also, to add on what she has said, majorly CRDB works, it's like there's a cycle between CRDB, the government, and the farmers and all those people involved in the country. So, which benefits CRDB in that they give loans to the farmers and to other people operating, and also these people then also they give loans to the government, and these people are sponsored by the government. They are given stipends. So when the farmers come, they take the loans, and then the cycle like helps the bank grow.
Also to add on that, the Kijani board, we consider that agriculture is one of the leading GDP in the Tanzania nation. So with factoring in Kijani board, we see that it helps in the growth of the bank, not only the bank but also the GDP, because it helps in sustaining agriculture and its development.
And Kijani has this thing they do once they get the interest. The investors invest the money they do it give back to the community, like Sadaka, the Sadaka account.
So based on your responses on the Kijani bond and also looking at the income drivers, how did this influence your self-decision? Because you've sold Kijani bond to us just now.
So, as I said...
Let me just add to that question because they are related. Maybe you could give insight in terms of the weighting, because you gave the DCF 10%, yet it was the one that was offering a buy recommendation. So I want to understand the logic behind the weighting.
So first, for the DCF, due to uncertainty in assumptions, we decided to give it 10%, so to balance any inaccuracies that we might have during discounted cash flow, our valuations. For the dividends, why we gave it dividends discounted model, why we gave it a 50%, is because we wanted to focus mostly on the actual performance of the company, and we know that dividends discounted model does give the actual performance of the company, and that's why we ended choosing 50. And the company, again, CRDB does pay dividends, every single year. And then for the EPS, we saw they have retained earnings, and they still pay dividends, so we saw it to give 40%.
One of the assumptions you used was a growth rate of 17%. Could you tell us about that?
Oh, so for that one, the industry growth is 17%, and we also compared it to our revenue. We did the revenue from 2019 to 2023, and we found 17%.
The economy is growing at 6%. How do you expect a company to grow 11% faster?
I think it's because the company, CRDB, is majorly focusing on its growth, as it's the biggest company in Tanzania, with the gap it has to the next, like the second leading bank, is a really big gap that there's such a big void, and that's why the things CRDB is investing in, like Akina Kijani and all the other things that is doing, the fact that is so connected with the government and all that, it's helping the bank grow at a larger rate.
And to answer your question why we gave a sale, we focused on short-term investors. One thing when we were doing our research, we found out that most investors in Tanzania are short-term investors due to we'll give you three reasons. One is because market liquidity. The Dar es Salaam Stock Exchange has a low liquidity, hence it is attractive to short-term investors. And number two is dividend focused. We found even CRDB investors are more dividend focused than the capital appreciation. And number three was the market uncertainties like interest rates, inflation, and that's why we saw, okay, if most of them are short-term investors, then we preferred to work with the short-term investors. And we know that the short-term investors, it's attractive it's strong for the long-term investors, but for the short-term investors, they'll have market correction before they see any gains.
Also to add on that, CRDB is highly profitable, it's well capitalized, and also it's financially stable, hence the growth, and it has a low debt and a strong credit capacity.
All right.
Thank you.
Thank you, Team F. Round of applause for Team F. Next, we'll have Team G. Team G, we can start.
Good morning, everyone. This is Team G. My name is Anne Gige.
My name is Beth Morgan.
My name is Onserio Stephen.
I am Nelly Kendi.
Is investing in CRDB Bank a viable option? Well, in the next few minutes, my team and I are going to convince you that investing in CRDB Bank is a viable option. We initiate the buy rating. Our target price is 127 Tanzanian shillings, which represents an upside potential of 113% from the last close of 670 Tanzanian shillings. In our view, the undervaluation of CRDB stock price is likely due to factors that have not been fully reflected in the stock price, and which include CRDB's sustainable growth trajectory, a robust return on equity, and ESG leadership. Therefore, our investment recommendation is centered around 3 key investment theses. Number 1, return on equity growth and projected strong returns. Number 2, cost efficiencies to drive profitability and sustainable growth. And number 3, green growth anchored in robust ESG foundations.
CRDB Bank started its operation in 1996 as a fully fledged commercial bank. Since its inception, it has grown its asset base to 13.3 trillion Tanzanian shillings, accounting for 27% market share by 2023. CRDB's headquarters are in Tanzania with 2 subsidiaries, one in Congo and one in Burundi. CRDB carries its operation through retail banking, corporate banking, Al Baraka banking, which is a Sharia-compliant banking, treasury, and capital markets. CRDB also has CRDB Insurance and CRDB Foundation, which is a non-banking subsidiary. CRDB funds its operation majorly through customer deposits, as shown in chart number 1, with a higher proportion being from the CASA accounts. It also has a diversified loan portfolio, as shown in chart number 2, with retail loans having 63% as at the third quarter financial year 2024. According to IMF, the Tanzanian economic outlooks remain positive, with the banking industry growing steadily, as witnessed by, number 1, expansions of the sector's balance sheet, which it has grown by 13.9% trigger CAGR as at the financial year 2018 to 2023. It also has improvements in its financial metrics, such as better asset quality and return on equity, as shown in chart number 4 and chart number 5. However, the banking industry faces a challenge in capital adequacy due to the pressure from the loan expansion. Into the regulatory environment, the Bank of Tanzania mandated the implementation of Basel II and Basel III with an aim of enhancing the industry stability. In Tanzanian economy, 5 banks command a 65% market share, with the CRDB Bank having a 27% market share, being their leader. In our view, the CRDB market position translates into a strong, solid balance sheet, which serves as a strong foundation for sustainable growth and a dominant market presence.
Dive in financial analysis. The capital adequacy ratio declined from a high of 19.9% to a low of 15.3%, which is above the minimum threshold of 12%, hence more capital surplus, as illustrated in chart number 8. As we move down, the cost-to-income ratio declined from a high of 66.9% to a low of 49.6% financial year 2023. And this brought about by the increase in the income, which is at 14% CAGR, outpacing the operating expense at 7% CAGR, illustrated in the chart number 9. The asset quality for the CRDB Bank grows while the NPL cover remains low. The NPL ratio declined from a high of 14% in the financial year 2016 to a low of 2.6% financial year 2023. And therefore, the cost of risk also declined from a high of 3.5% to 0.7% financial year 2023. We forecast a risk charge of 1% and also NPL cover to reach 74% financial year 2027. CRDB Bank loan book have grown from 3.1 trillion to a high of 8.9 trillion financial year 2023, and this we expect the fluctuation in the net interest margin from 7.9% financial year 2023 to 8.1% financial year 2024 to further to 8.4% financial year 2027. The net interest income is projected at 16.9% financial year 2027 SEGA. The loan have grown by 25.2% financial year 2023 SEGA, and the LDR has risen from 63.9% to 96.7% financial year 2027. And taking note of the recent LDR, we project our borrowings by 15% since the bank will need additional funding from outsides. The ROE ratio rises from 8.5% to a high of 25.2% financial year 2023, and the dividend payout ratio for the bank stands at 35%, and we believe that the bank will maintain the dividend at 35% as per the CAR requirements and the financial outlook.
We derived our target price of 1,427 Tanzanian shillings using a two-stage dividend discount model. Our cost of equity is 19%, our assumed return on equity is 24.9%, and our assumed perpetual growth rate is 7%. In stage one, as highlighted in table number 1, we calculated the present value of dividends for the financial year 2024 to financial year 2027, and we derived a present value of 254.5. In stage 2, we generated a terminal value as the book value per share estimated for financial year 2027 based on our assumed return on average equity of 24.9% and our assumed perpetual growth rate of 7% to generate a terminal value of 1,976 Tanzanian shillings. We then discounted our terminal value back to our cost of equity to derive a present value of 1,172 Tanzanian shillings. Our present value of terminal value and our present value of dividends sums up to our target price of 1,427 Tanzanian shillings. However, our target price is highly sensitive to our cost of equity and return on average equity assumptions. Therefore, we conducted a sensitivity analysis as highlighted by table number 2 to illustrate the impact that changes in cost of equity and return on average equity assumptions will have. For instance, we increased the cost of equity by a margin of 1.5% to 20.5% and reduced our estimated return on average equity to 20.4%, which typically reduced our target price to 1,000 Tanzanian shillings.
Proceeding to investment risk, first we have liquidity strain. This risk might arise due to the bank's LDR trading higher, which might force the bank to rely more on wholesale funding and borrowing, which might reduce net interest margin. Secondly, we have a low NPL cover. Despite the bank improvements on its NPL cover still remains below its historical levels, which might raise concern about the potential future risk changes. Then we have the transition risk. As the bank is trying to align its operations with the low carbon economy, that 2.5% of its loan portfolio is exposed to transition risk, which might trigger the bank to allocate more loan provisions. Shifting our focus to the bank's ESG, first we have the ESG credit impact. According to Moody's, the bank holds a neutral to low ESG credit rating, suggesting a stable investment outlook. Secondly, we have GCF and GCF accreditation and the Kijani board. CRDB Bank being the first bank in East and Central Africa to be accredited by the GCF, it has launched a Kijani board as an additional source of funding, which so far has seen a great success, as its first tranche, which was raised in 2023, has been oversubscribed by 29.6%. Further, we have gender diversity and inclusivity. The bank's workforce fosters gender inclusivity and diversity, as 56% of its members are males and 44% of its employees are female. The board composition, The board consists of non-executive and independent non-executive directors, fostering a diverse professionalism. Going to the governance committee, the bank has specialized governance committees such as the credit, the audit, the risk, and the HR committee, which assists the board in monitoring and advising on the key strategic plans, thus fostering a robust governance.
In conclusion, we recommend a buying rating for CRDB Bank. Thank you.
We open the floor to questions.
Thank you for your presentation. So I have a question on your peer analysis. Please speak to that and elaborate why you chose those companies as the benchmarks.
Pardon question?
Sorry?
Pardon the question.
Peer analysis, your comparable companies for your ratios.
We did not conduct a relative valuation in our analysis. And in the further stages, we will incorporate the relative valuation to give a broader view on our and a comparison of our results of the dividend discount model.
I feel like your recommendation might be a bit aggressive. So I want to ask, what are the key strategies for growing the bottom line that are not specific to cost cutting, that are actually about profitability more than efficiency? Yeah.
So aside the cost efficiencies, we've estimated a fluctuation, a positive fluctuation in net interest margins. Number one, this will be as a result of CRDB's financial inclusion initiatives. As we've seen, the CRDB Bank has launched Al Baraka banking segment, which is in a high growth phase, characterized by an increase in profit before tax of 116% for year-on-year growth from financial year 2022 to financial year 2023, and also an increase in their customer base under Al Baraka banking at 341%. Secondly, we view CRDB's market position to be a competitive advantage for the rest of their competitors. Since they have a larger asset base, then we view that CRDB will be in a greater position to take advantage of the growing Tanzanian economy. Yeah.
To also add on that, we see that CRDB has also expanded its regional base to Burundi and to Congo. We believe that as much as they continue, they are able to grow their asset base, hence they'll be able to increase in their productivity and in their customer reach. Thank you.
I have two questions. One, you have indicated a very high upside potential. Which areas do you think CRDB has not ventured in to take advantage of the potential?
First, you'll allow us to handle the question I and on Serio. I'll talk about the 19% percentage which is financially excluded. In our view, the financially excluded percentage will give the bank advantage to expand further, and that one will increase the bank's income and also the profit for the coming years.
Looking into the position of CRDB Bank, CRDB Bank has a higher operating expense as compared to its competitor, NMB Bank. Therefore, CRDB Bank, while improving on their technological investments, then we believe from the projects we've seen that CRDB has launched, then we believe they are venturing into innovation will reduce their cost efficiencies and improve on their profitability. We've seen NMB's operating expense at 36%, while CRDB's operating expense is 49.6%. Therefore, their investment in innovation, we believe that CRDB's ultimately going to catch up with NMB in the future.
Just
So
to
on
clarify.
your loan deposit ratio concerns, how do you think they're going to address them?
Pardon the question, kindly.
In your loan deposit ratio, you have concerns about that. How have you resolved the issue in your forecasts? How do you expect them to overcome that 96% loan deposit ratio?
Okay, on the loan deposit ratio, as a result of the increase in the loan deposit ratio, we forecasted our borrowings by 15%. And as a result of forecasting borrowing by 15%, we saw it better that the bank will need additional funding from outside. And as for that, the bank needing additional funding from outside, it will use the borrowings to finance itself.
What assumptions are you putting in for that borrowing externally, and how does that impact your net interest margin?
The CRDB LDR ratio has been conducted. According to our assumptions and our estimate, it is increasing highly. And this might force the bank to rely more on the external borrowing and wholesale funding, which might trigger our estimate, and this is costly. Thus, it will lower the net interest margin of the company, and this might lead to a low profitability.
And in the effect on the net interest margin, when it is increased, it will make the net interest margin to fluctuate from 7.9% financial year 2023 to 8.1% financial year 2024, and further to 8.4% financial year 2027, since the borrowing are also increasing, and we've risen the borrowing by 15%.
So how will you borrow more and your net interest margin is going to expand? You're saying you're borrowing at a higher cost. I can ask it another way. You're saying your net interest margin is going to go higher from 7.9 to 8.5, isn't it?
Four.
Did I get that right?
Yeah.
Your net interest margin is going to be higher in the forecast. Yet, you're going to borrow more money externally at a higher cost. So how shall your net interest margin grow to 8.5?
So a point of correction, my teammate has conflicted his information as from what he has informed me, because we believe that higher borrowing costs will lead to lower profitability, since the cost for the bank's funding will be higher. Yeah.
Just saying, unless you increase the borrowing costs for the actual customers, that's the only way. What you're saying.
Yeah, sure.
That's fine. I wanted to just get a clarification quickly before we finish. The 2024 numbers, are they real or actual? Or are they actual or projected?
We estimated. We estimated. Yeah, yeah.
Okay. Thank you.
Thank you.
Thank you, Team G. Round of applause for Team G. We'll now have our final team from the first round, Team H. We'll give the judges a minute to conclude their scoring for Team G, but Team H can proceed to the stage. Team H, your time starts now.
Good afternoon, ladies and gentlemen. My name is Nicodemus Msamutuku. From my left, you have Jojo Duor, Marion Siriba, and Victor Chuma. And we welcome you to our presentation of the largest bank in Tanzania with a 52-week target of, with a 52-week target of Tanzanian shillings 550. Last close was 670, an upside of 28.7%. We undervalued our subject company with a recommendation of hold, with income drivers being interest income and non-interest income. In interest income, we have loans, savings, customer deposits. In non-interest income, we have charges on late payment, credit on annual charges in activity, fees, commission. The subject company became a fully fledged commercial bank in 1996, listed in Dar es Salaam Stock Exchange in 17 June 2009, with a total asset base of over 16 trillion, over 251 branches, with the staff 4,175, customer deposits 10.3 trillion, customer base of over 5 million. I now welcome George to take us through industry overview.
Under the industry overview, these were the following things that we considered during our research. Number one, we considered supply drivers. Under the supply drivers, we had the following. Number one is service experience. Number two, we had the growth enablement. Under the same, we checked on the demand drivers. Under demand drivers, we have acceleration of technology and infrastructure. Number two, on the same, we checked on the on the same, we checked on the challenges. Challenges, number one, we checked on the number one, no access to credit facilities for the small business enterprises. Number two, we checked on the lack of proper financial records so that they can acquire loans. Under the same, we checked on the banking landscape in Tanzania economy. Number one, we realized that in Tanzania, in March 2024, as at March 2024, the bank has 47 licensed banks, 34 commercial bank, 4 community bank, 2 development bank, 1 mortgage bank, and one yes. On the same, we checked on the performance. Under the performance, the Tanzania banking sector remained liquid, profitable, and capitalized. In that, assets and loans remains improved. Yes.
Next, I'm going to talk about competitive positioning. Therefore, we came up with the CRDB is the largest bank in Tanzania with the 16.04 assets, 27% of the loan market, 54% of the mobile banking markets, as well as 42% of overall share of the market in Tanzania, as well as is the largest and the first green bond market in sub-Saharan region.
Under the ESG, that is the environmental, social, and governance, which is the driving sustainable business environment. When I start with environmental, whereby CRDB Bank supports climate finance and collaborates with climate change mitigation projects. And then I move to social, whereby CRDB Bank sets 1% of its net profit for corporate social investments, which is directed to the environment, education, health, youth and women. And in terms of governance, the management provides quarterly updates. To governing teams and on sustainability risks and opportunities, and thus impacting teams' performance.
Next, we move to risks. That is risk analysis, where we came up with a matrix that we used to determine the risk, and 3 of them were so key to us. That is political instability, cybersecurity and fraud, competitive markets, and whereby we expect that CRDB, in terms of competitive markets, will mitigate this through providing more services and products, streamlining their operations, as well as coming up with effective customer service. When it comes to cybersecurity and fraud, we expect them to invest in security system and an effective framework to deal with fraud. In terms of political instability, we expect that they will come up with contingency plans for the same, as well as make open communication to stakeholders.
Under financial analysis, we carried the following 4 assumptions. 1, increasing ROE from 24.2% to 28.1% from 2023 to 2024, whereby, as you can see in our line chart 1 and also our proportional distribution 2, you can see that over the past years, the ROE has been increasing, therefore, meaning that the bank is having high profit growth. The second assumption is that the deposits are growing at a faster rate than loans. So when you look at the first chart, the second one and the third one, you can see that the deposits are growing at a faster rate than the loans, and also the shareholders' funds. And when you compare the shareholders' funds and the loans, the deposits occupy a larger percentage. So this means the bank has a higher lending capacity, meaning that it will generate higher profits in the future. And also, the third assumption is that the NPL will follow a downward trajectory of 1.2% by 2026, whereby when you look at the line chart 1, it is showing the NPL downward trajectory from 2023 to 2024, and the other one is showing the NPL downward trajectory from 2020 to 2026, which is showing that the downward trajectory, this is an assumption that we made, that the bank is going to have a higher loan portfolio quality. The fourth assumption is that operational efficiency following continuing digitization of the bank's operations. And as you can see from the diagram 1 and diagram 2, Simba banking grew by 31%, agency banking grew by 21%, ATM income grew by 21%, and also when you look at the regulatory limit, you can see that it is reducing over the years. So that means that the bank's operations will be at a his process, therefore generating more profits in the future. When you go to the valuation, our valuation was based on the following assumptions. 1, absolute valuation and relative valuation, whereby in absolute valuation we had DDM, and in relative valuation we had relative valuation we had multiples, whereby the intrinsic value through DDM analysis we had 730.43. The intrinsic value through multiples is 556.6%. We weighted it through 60% and 40% with DDM and relative valuation to get an average share price of 643.56. Therefore, giving us the reason to undervalue our subject company with the recommendation of hold. And we also ran a Camel's analysis in order to support our financial and the valuation analysis, whereby we consider the following apparatus: 1, capital adequacy, asset quality, liquidity, earnings, sensitivity to market risks, and as you can see, the line chart 1 shows profit growth, which is going to be, thank you. We now welcome the questions.
Thank you for your presentation. So in relation to the non-performing loan trajectory, could you kindly highlight what will CRDB do different to ensure that there's a decline in that percentage?
Could you pardon, please?
So my question is revolving around the NPL trajectory.
Yes.
You've highlighted that it's going to drop, I think by year 2025. So I want to know or understand what will CRDB do different as opposed to the other years to ensure that that decline is there.
Okay, one thing that we did when we looked at the NPL for CRDB Bank over the past years, we noticed that the NPL has been maintaining a downward trend trajectory. So we took the values, we made an addition, and then we made an average, and also we got an average, and then from that average we provided the line graph that you saw, and also we compared it with the industry average, and therefore we saw that within the next coming years it is going to be at a lower rate. Therefore, this will show that the loan portfolio for CRDB Bank to lend will be high. Thank you.
Can I add something? Are you asking what criteria they will use in the?
Yes, I'm asking, given the fact that the number has been reducing, what ways or what methods have they been using to ensure that that percentage is declining?
Okay, as far as my understanding I can say that the loan portfolio was really based on let's say agriculture and the mining industry. So the diversification of the portfolio into maybe other sectors such as corporate retail and other things, that's what I saw highlighted on their investors' reports. Yeah, so we can say whatever they are doing that is working, so probably they will continue on the same and still add other strategies to it that we have not yet known, that is not disclosed to us yet. Yeah.
Thank you for your presentation. You've indicated that the deposits are growing at a faster rate than the loans. How will it be an opportunity for CRDB Bank to grow its profits?
Okay, if the deposits are growing at a faster rate than loans, this means that the bank will have more liquid cash to lend. So if the bank has got more liquid cash to give out to borrowers, this means that it is going to yield profit. That is maybe from the income drivers that highlighted on the first page of a slide, whereby perhaps maybe there are going to be charges on late payment, fees, transfers, commissions. So through that, the bank is going to realize a huge profit, therefore lifting the bank's dividend growth and profit growth, and thus expansion of the bank as a whole.
I have a question.
Yes.
Thank you for your presentation, by the way.
Thank you.
The insurance business of CRDB is new, right? It's not been forever.
Yes.
I want to understand what percentage of the insurance business covers the income that comes to CRDB in general, and how is that percentage increasing year on year? Is it higher than actually the net income? When you compare, how is the percentage contribution of the insurance business portion for CRDB?
So you're asking the insurance?
The insurance arm of the business, see, they have many product offerings and service offerings.
Yes.
With regards to insurance, you mentioned the different distributions. I'm asking with regards to insurance, how much is that percentage share of the income that comes to CRDB? And how is it changing year on year?
Okay. The percentage change, I think it is around, when you add from Simba Banking, the agency banking, insurance, the ATM incomes, all those, it is coming at around 70%. And for me, I would say that now that the insurance is now more being digitalized and more being mobilized, this is encouraging many segments and many other customers to take insurance with CRDB because they are assured because of the ease processes, because of the assurance that it is going to grow with time, and also assurance that it is also going to make sure that it covers them on time. Therefore, I think this will attract higher numbers, and this will contribute to perhaps maybe 80% in future.
Tell me how you came up with your calculations that you used in your DDM, especially how you came up with your cost of equity.
Okay. The figures that we got on DDM, we simply did assumptions from our financial analysis, and we also got them from the CRDB reports, and then from there we basically did assumptions of the figures that we did from CRDB reports. Then using CAPM, we calculated the figures that we got and then arrived at the figure that we have.
Thank you so much for your presentation.
Thank you.
Thank you, Team H. Round of applause for Team H. So we've officially concluded round one. Congratulations for making it this far. We'll give the judges some time to finish their scoring. After that, I'll be able to tabulate that, and we'll be able to announce the top four. So top four, like I mentioned before, is 50% your written report and 50% today's presentation. So top four will proceed to round two, which will be after lunch. But right now, we'll give the judges a minute to finalize on the scoring, and then tabulation, and then announcement of the top four. Then we can proceed for lunch. deliberate amongst yourselves. But that will be the plot, and it has thickened. All right, so in no particular order, top 4 teams. Team B. Round of applause for Team B. Team E. Round of applause for Team E. Team G. And finally, Team A. Please bear in mind that this first round was a combination of 50% of your written report, which was graded, and 50% of your first round of presentation. So the aggregate of that is what has qualified you into the top 4. All right? So we'll have Richard Mureithi giving a few comments for their expectations for round 2. Welcome, Richard. Round of applause for Richard.
So good afternoon. We're looking at some statistics because after all we're mathematicians in this room. And of the population in the world, the number of people who say that they have a real fear of spiders is about 3.5% of people. The people who have a real fear, of heights, being put in, a very high space and looking down, that's about 10% of people. Do you want to take a guess on the number of people who say speaking on a stage like this is something that fills them with anxiety? Do you want to take a guess? Any guesses? So, Koki says that it's 70%, and that's absolutely right. 70% of people cannot fathom coming up on a stage like this. All of you this morning were able to do that. You're clearly exceptional people. So for those who participated, just being here, that is a remarkable feat, and I applaud you for that. For those who are carrying on and coming back on this stage to face their fears, we look forward to meeting with the 4 teams. And investing is about making judgment about an uncertain future. So our work as financial professionals and professional investors is to try and understand the future, make as much sense as we can of it, but the future still remains uncertain. We expect you, when you come on this stage, to clarify as much as you can to us about the future of CRDB. We know that it was founded the year it was founded. We know that they have financial results running from this year to that. We want to hear about the future. If you liken an investor to somebody who's stuck on an island trying to get to the mainland, and we have a raft, and there are many waves which are coming. We have to decide which wave we're going to time in order to meet our objective. So we are making assessments of very many things. We want you to help us make that assessment of CRDB to filter out what is important, what is critical for us to know as we are on this raft trying to make our way across the ocean to the mainland. So over the course of your lunch, cut down your slides, make them 5. The discussion is going to be more about the future of CRDB and what it is that you would like us to know, and the questions will be centered on that. So I'll invite Joyce to tell us where we're having our lunch, and see you in the afternoon. Thank you.
Thank you so much, Richard. Round of applause for Richard. In the interest of time, we will have lunch in exactly 40 minutes. Yeah? Sorry? No. We will have lunch now, but we will have a duration of lunch for 40 minutes. Koki, you're confusing me. So we'll have lunch for 40 minutes. We'll assemble back here at 10 minutes to 3, okay? And that will allow us time to prepare. For those who are preparing during lunch, I'm sorry you will not enjoy your lunch, but this is what competition entails. So we will have the 4 teams that are not, that are presenting, going back to that small room, okay? So until your peers, until you perform, until you present, that's when we'll be able to invite you back into the room, okay? So we will start just the way I mentioned. There was Team B. Team B will be the first. Then there'll be Team E. Then we will have Team A, and then Team G, in that order. Are we clear? The 4 teams, are we clear? All right. So the first team, you come back with the rest of us, but the other 3 teams, you go back to the small room. We are having lunch at the restaurant, just outside, towards the left, towards the end of that road. Not road, but yes, at the corner there, on the left. See you in 40 minutes. Ten-minute presentation and then Q&A.
So good afternoon.
All right, your time starts now.
All right, good afternoon, judges. My name is Sasha Wamalwa.
I'm Joy Msingo.
Nicole Sana.
Shanice Matola.
Winfrey Shalom. All right, so as I initially stated, CRDB's aim is basically to provide great socio-economic value to all its stakeholders. And this is why me and my team, we are back here to reinforce our standing, in which we believe that we should issue a buy recommendation at a target price of about 42 Kenyan shillings. Now, looking into the future prospects. So currently, agriculture is CRDB's top contributing sector at 42%. But real estate and trade show great potential in these coming years for CRDB. I will start with real estate. So currently in Africa, there is a macro trend of urbanization. And definitely Tanzania is not being left out with this, with the population in Dar es Salaam and cities like Dodoma growing very fast. So when we look at CRDB, we're able to see that they hold the current mortgage market at 36%. With them holding such an amount of 36% in the mortgage market, they're clearly able to benefit from housing and finance products in the coming years. Nextly, I would like for us to focus on the trade, which currently stands at 14%. There has obviously been conversation about the SGR being put up in countries such as Tanzania and also Uganda and Rwanda and Burundi. They already have a subsidiary in Burundi, which is doing very well, and this will just contribute greatly in the coming future. Now, when we look at Uganda, they also have prospects of opening a subsidiary in Uganda. And so that means CRDB in the future years can be looking at benefiting from the increased trade that will come about. Now, I would like for us to take a deep dive into the industry analysis. So, the GDP of Tanzania has been growing at a rate of 6.19%. Currently, we can see that the banking and the finance sector has grown from 2.3 to 8.6 in 2023. Assuming that the political situation in Tanzania and everything else stays put, we do believe that by the time 2027 reaches, that a steady growth will still be seen in the banking and finance sector in Tanzania. I'll hand over to my colleague to continue on the future prospects.
Now, looking at the investment summary, we focus on three main theses. The first one being the market leadership and the future outlook of CRDB. So what exactly are we expecting for the future with regards to CRDB? We expect them to target a market share of 30% of deposits by 2029. We also expect the cost-to-income ratio to drop to 45% by 2029, which shows an improvement in their operational resilience. Coming forward, we look at the NPL ratio, which is currently at 2.8%. We expect that to go further to 2.5% by 2029, which is well below the industry average. We can also see that on the graph that there's an aggregate growth within the profit after tax, which shows strong profitability. Moving on to the next thesis, we have strategic growth and regional diversification. And as you can see, they have plans to expand to Asia in the future, Zambia, Uganda, and Comoros. And currently they are in DRC, Burundi, DRC, Congo, and Burundi. For DRC and Burundi, they give 6% profit after tax to the group, and DRC is expected to grow at a 15 to 20% CAGR in the coming years. Additionally, Burundi, being the most profitable branch, expects to target a market share of 20% deposits and 25% total assets in the future. We also expect the non-funded income to grow by 35 to 40% by 2024. Looking at the final thesis, which focuses on the financial metrics and ESG, we have a capital adequacy of 17.3%, which is well above the industry average. Additionally, they expect the green finance to increase from 15 to 20% of the loan book, which also reaffirms that CRDB is the largest green financial institution in Tanzania. We also have the Kijani bond, which is oversubscribed and is expected to perform better in the coming years. And we can see that it's one of the ESG leaders. Let my colleague take you more through the ESG.
The environmental, social, and governance initiatives by CRDB Bank is a part of their 5-year Evolve strategy. CRDB has proven itself time and time again, not just to be a follower of global developments, but a trendsetter. Now, looking at their environmental initiatives, the future of CRDB holds a reduction in carbon emissions by 10%, as well as a reduction in water consumption by 25% by the year 2030. Not only do they intend to reduce their carbon footprint, but they also intend to cut paper usage by 20% by the year 2025, as well as roll out light-efficient LED and sensory lights across outlets. Socially, CRDB currently has a 56 to 44 male to female ratio, which they're intending to close to 50-50 by 2027. They've also established the CRDB Foundation, aimed at empowering women, youth, and small-scale farmers. They also support healthcare initiatives with local healthcare centers, as well as have been recognized with awards for SME banking. Their governance initiatives include a rotational structure for their board, which enhances fresh and diverse perspectives, as well as board committees for audit, risk management, and compensation. They intend to have strong ethical standards, whistleblowing policies, and stakeholder engagements. And CRDB has consistently proven itself to be adaptable, which is necessary in a world inching closer to sustainability.
When you take a look at the numbers, we can see that CRDB has shown great financial strength. Revenue has grown consistently over the past 5 years, mainly driven by interest revenue with a CAGR of 20%. By the year 2028, we expect the revenue to grow to 2.64 trillion. Moreover, the key performance indicator set of the industry set it far apart from its peers. The non-performing loan ratio stands at 2.8%, and we expect this to reduce 2.5% by the year 2029 due to loan default management strategies implemented by the bank. Additionally, return on equity stands on 26.7%, which we expect to increase to 30% by the year 2029. This is due to the expected growth in customer deposits. When it comes to cost analysis, CRDB has made remarkable improvements. Cost-to-income ratio stands at 49.5%, which is within the bank's benchmark of 50%. And this is also in trend with the bank's goal to achieve a cost-to-income ratio of 45% by 2029. Lastly, liquidity stands at 27%, which we expect the bank to maintain in the coming years so as to meet the industry requirement of 20% while also having enough money to make strategic investments?
At the beginning of our presentation, we issued a buy recommendation with a target price of 836.1. Allow me to take you through our valuation methods to explain and reaffirm our position. First, we did a dividend discount model, which we weighted at 60%, and this resulted in a share price that's a 25% upside from the current price. The reason why we used a dividend discount model is because CRDB has a history of paying dividends to its shareholders, and it allows us to flex the macroeconomic assumptions about the environment in Tanzania. Also, an investor is mostly concerned about how much dividends they do receive from their investments, and that is why we gave it a higher rating. Second, we did a residual income model. We did a residual income model weighted at 30%, and this resulted in a share price that's a 41.6% upside. We used the cost of equity and a growth rate that are consistent with our DDM model, and our growth rate was informed by the GDP growth rate of Tanzania. Lastly, we did a Monte Carlo simulation to capture the uncertainty that's involved with the two book methods that we used previously. We also did a sensitivity analysis to provide further insight. However, we do maintain a positive outlook about the environment in Tanzania. Hence, we expect the share price to be between the base case scenario and the optimistic scenario. Lastly, we looked at the investment risks that are associated with our buy recommendation. First, we have their high debt to equity ratio. However, for this, they do mitigate it by looking for alternatives such as cheaper financing, which such as the Kijani bond, which is in line with the ESG framework. We also have economic and political risks, especially in the subsidiaries in Burundi and DRC. However, for this, they do have country-specific frameworks in place to mitigate that. We have the impact of climate change, and this mostly affects the loan portfolios in the agricultural sector. However, for this, they do have capacity building sessions for the relevant stakeholders in order to help mitigate this. And lastly, we do have security threats due to digital infrastructure, which is mitigated by advanced security measures. And this is why we, as Team B, confidently issue a buy recommendation. Thank you.
So I think it was amongst the first ones. There was a chart there you heard of your profits. Further up, towards the beginning. There. So these are your forecasts for profit after tax. So you expect a big increase in your profitability between 2026 and 2027. That's right. So you could speak to that. Why do you expect such an increment in profitability for that year? And thereafter, you're forecasting a decline in profitability. Is that right? So you're saying revenue is going to increase. You're saying that their cost-to-income ratio is going to improve and go all the way down to about 45%, but their profitability is going to be less. I would like to hear more.
Regarding the profitability, we put other aspects into it. So we expect them to, again, they were expecting to expand into like other countries such as Asia, Uganda, and Comoros. Additionally, we expect, a certain instability during election time. So as you can see, there's a dip, but we expect it to go up now after elections have gone past that. Yes.
I'll kind of like add on to his question, but from a different angle. So the general feel of why you're giving a buy recommendation is because there's going to be a lot of growth, right? And a lot of that growth relates to capital expenditures. So I don't know, how have you accounted for those capital expenditures in your future financials? Because they're going to be intensive on that. how is that factoring into your valuation?
So as much as we have accounted for capital expenditures, just as my colleague has mentioned, things such as them branching into other countries, such as Uganda, as mentioned. But as much as they're having these capital expenditures, as I earlier mentioned, we're also experiencing a lot of growth and macro trends that are increasing the revenue that is coming into CRDB. And so we believe that's actually going to offset, hence us still pushing for a buy recommendation.
Does it have any implication on that drop there between 2025 and 2026?
The main reason as to why that drop is there, just to reinforce what my colleague has said, is because there have been political talks about the whole Tanzanian politics and all of that. And so we just found it wise to actually incorporate how that can actually affect the movement of profit and different sectors in the economy, just based on that. Yes.
Thank you again for your presentation. So I think a similar question to what others have asked. I guess it's around, I think you had the slide with the sectors. So you had agriculture, and then you had real estate, and also you had trade as kind of the drivers. Can you maybe give a view for us, given the regional expansion and the kind of growth in market share, which one is the more of a weight in terms of the growth that will come in the future? Which one is the main driver?
Let me just, as my colleague moves to the slide, let me just clarify your question.
Sure.
You're asking, I give you an overview of what maybe I want you to just...
Yes, so I think it's the next one. So if you,
The next.
so this one, this is what you were talking about, where a lot of the contributing growth is coming. You focus on agriculture, right? Mainly as the kind of key sector, but you talked about trade and others, right? So I'm just trying to get, are these the sort of sectors they're also expanding in some of the regions, or is it happening mainly in Tanzania that you're seeing that growth? Just give a view of that. In terms of
Okay. Thank you for your question. So this, when I talk about the real estate and the trade, it's mainly in Tanzania, but then I'm not limiting it only to Tanzania, because for things like real estate, as I earlier mentioned, it's a macro trend that's currently happening in Africa. A lot of the population is growing, and not just in Tanzania, it's also growing in DRC and various other places that they could open their subsidiaries to. So once they stand a chance to benefit from this, also in different countries that they choose to expand into. Thank you.
So in relation to Kijani Bond, could you kindly elaborate on what implementations you put in place to ensure that the bond overperforms in the future?
Okay, so part of their plan is to have third-party international audits. So we've got the UN GCF, as earlier mentioned, as well as the international CMA, and their policies reinforce that the Kijani bonds comply with the policies generally, as well as generally transparency that comes with green bonds. So there are penalties associated with non-compliance, and that would only push forward for the green bonds to succeed, as well as the general performance of sustainability tends to look upward. So that on its own is also a...
Let me ask something related to that slide, because I don't want you to move from it. So in terms of the different product and service offerings that CRDB does, you've given us the growth in terms of the segments, this segmentation of industry. What about in terms of the current service offerings? What are you seeing as being the key service offering drivers of the growth that you're seeing? And maybe I can tie that with, you mentioned that the non-financial income is expected to grow by 35%. What supports that non-financial income growth? Because it's not part of the key business, essentially.
All right, so I'll tackle the first part of the question, and then I'll give my colleague to tackle the second part of the question that deals with the non-financial income. Is that all right? Yeah, so basically, CRDB, as I earlier stated, is that in terms of the mortgage market in Tanzania, it has 36% of it. That's actually quite a big share in which it occupies. And so with this product offering, that's why I link it to them benefiting from the growth in which will come from areas such as real estate.
I have a question on your valuation slide. Further, a bit further. There. So I'm looking at your valuation assumptions, and the risk-free rate is 11.44. So that's what I can earn if I don't do anything. Yeah, I can make 11.44%. The cost of equity for this business is 11.99, or call it 12%. So there's a bit of a premium there of about 0.5%. Do you feel that 0.5% above risk-free, where I do nothing and earn that return, makes for a good investment case?
Yes, we do. And our numbers confirmed that, because despite the risk-free rate being slightly lower by the 0.5%, our valuation gave us a 25% upside. So you would be, as an investor, you would be at an advantage if you invest with CRDB.
Did you guys do a competitive analysis? Because I've not seen you comparing CRDB Bank with its competitors and coming up with the strategies. Did you do a competitive analysis?
We chose to focus on the dividend discount model, the residual income model, and Monte Carlo simulation, because through our analysis, we felt that those would best provide an investor with conviction as to why they should buy the CRDB stock. Thank you too.
B. Next, we'll have Team E. All right. Okay, we'll talk. We'll give the judges half a minute to complete their scoring. All right, Team E, your time starts now.
Dear jury members and guests, this is Team E with our equity research report on CRDB Bank PLC. we initiate a buy recommendation based on a one-year target price of 840.05 Tanzanian shillings, representing an upside of 23.5%. So the rationale for this buy recommendation is backed by the following three propositions. CRDB is a market leader with robust business model and economies of scale. CRDB Bank has presented itself as a financially inclusive bank, therefore focusing on banking the unbanked, and therefore looking into the future, currently looking at CRDB's major source of capital, it has a 78% composition of its funding from customer deposits. Therefore, it has a very, essential focus on financial inclusion and continuing to diversify its revenue segmentation and market outreach. Therefore, going forward, we expect CRDB to continue dominating the Tanzanian banking sector, although there is stiff competition from top guns like NMB, Exim, and Stanbic Bank. The initiatives that the leadership of CRDB has put in place to ensure that it maintains its market leadership is immense. A second proposition is stable financial performance and return prospects, which is reflected in its year-over-year growth in return on equity and return on assets. Going forward, both the ratios are projected to be upward moving. From our period of analysis, from the historicals, we observed that there's no single year that CRDB has experienced a downside in its revenue, and it's in return on equity and return on asset. Therefore, this growth is expected to be projected in the future, and it's expected to continue generating immense amount of income to support its customers, its operations. Sorry. The third proposition is accelerating sustainability and ESG. A study conducted by KPMG in 2023 indicated the study was about the relationship between ESG performance of companies and the access of funding. So this is what the insights from the research indicated. There's a very strong positive correlation between a firm's ESG performance and access to funding. So what does this imply? That any firm that does not position itself in a sustainability manner, in a manner that incorporates ESG, and the climate sensitivity is it's supposed to suffer in the future in terms of access to funding. So what has CRDB done to ensure that it positions itself positively to investors? It has accelerated, it has incorporated sustainability and ESG in the core of its operations, meaning that by attracting climate-sensitive investors, it is able to acquire funding for its operation and therefore continue with its forward-looking. Thank you.
Tanzania's banking sector has been estimated to be growing at the rate of 17.3%, with CRDB Bank dominating 15.7% of the market share in deposits in the banking sector. This shows that there is a possibility of the bank growing, and since it is the largest bank in Tanzania, we can see that the top 10 largest banks in Tanzania dominate 77% of the market share in CRBD. We also analyzed the five forces, which shows that the industry rivalry is the force that poses high risk to CRBD Bank. So CRDB Bank should work towards reducing the risk.
So let's focus on the demand drivers. So World Bank estimates the GDP or the economy of Tanzania to continue growing at a rate of 6% in the long term. So what does this mean? The economic growth rate is directly, or there's a positive, there's a direct relationship between the economic growth rate and the growth rate of a particular company in a given industry. So we see that the Tanzanian economy, as World Bank's estimates, is expected to be growing at a rate of 6%, and then this is expected to show itself in the growth of CRDB. CRDB. Additionally, the SME sector in Tanzania contributes approximately 30% of the total GDP of Tanzania. Therefore, with this contribution to the total GDP, it means that there should be a very keen interest on the SME sector because it's an emerging market, and therefore, from the revenue segmentation of CRDB, it generates a substantial amount of its revenue from SME, and that's its forecast. It's forecast to improve on SME financing.
On profitability, CRDB has had a consistent net income growth over the past 5 years. It had strong returns on both the average equity and assets. Both interest and non-interest income have also contributed positively to this growth. This is an indication of a well-diversified and well-equipped management in CRDB. On liquidity front, CRDB has positioned itself as a market leader in Tanzania with an impressive year-over-year increase in customer deposits. Notably, 78.5% of these deposits, of its funding comes from these deposits alongside this strategic investment in treasury bonds, including Kijani Green Bond. Moving forward, or looking forward, CRDB is looking to leverage on digital transformation through investment in internet banking, ATM network, SIM bank, and agency partnership, which will help it as a competitive edge.
To summarize, the future of CRDB lies in empowering local communities in investments such as mining, agriculture, and agriculture, in tourism. In Burundi, it has focused on agriculture, especially in tea and coffee farming. In DRC, it has focused on the abundant mineral. CRDB is aiming to be a transformational leader in Africa by enhancing SIM banking, therefore promoting financial inclusivity. Thank you, and you're welcome for any questions.
Hi, thank you for your presentation. Could you please go back to the slide that had customer deposits and also net income? Just before that. So the year-on-year growth in customer deposits, there is quite the dip from 2022, 23, and the previous one. The next slide, sorry. There's also a dip in the net income. Could you please comment on that?
Pardon, what's the question, please?
There's declines in both the net income and the customer deposits.
Oh, the decline in the blue line. Yes. Okay, the blue line simply represents the year-over-year growth. So it typically shows the percentage change from the previous year to the current year. But when you look at the bars, you see they are going upwards. So simply what that indicates is that, you know, CRDB CRDB generated more income in 2023 as compared to 2022, but the growth rate of that income is much less compared to the increment from 2021 to 2022. But overall, the income has increased, as indicated by the bars. So the blue line indicates the year-over-year growth, which has declined by a margin.
Yeah, so it's to ask.
I wanted to add.
There's a year-on-year, it's growing, but at a decline rate. So could you comment on that? That was my.
Yes. You can see on liquidity, you find that CRDB has had over the market, which is probably 20%. And over those years, it was probably more than 20%, which showed that it surpassed those industries in the market like Citibanks and other competitors. So that's why we say that it is well positioned, no matter the small changes that it is going. Thank you.
I have a question on that slide. Please tell us about the key assumptions which you used to make your forecast for non-interest income.
Or the focus for the non-interest income. Okay, the assumptions typically are the previous growth that the income has been, the rate that the income has been growing in the previous is expected to be projected in the future because it has somehow shown some stabilization from probably when you look at from 2019 to 2023, it's been increasing, so we assumed CIBD to be growing its income at typically the same rate going forward.
Also, in addition to that, you can say CRDB, we projected this to go forward because it is expanding into other regions, and as you know, interest and non-interest incomes where you get income from non-loans, like you find that in a company, you have more customers, and maybe you give more loans. So that's why it is good. We projected it to grow.
But maybe let me ask that question in a different way. What is the makeup of non-interest income with regards to CRDB? And have you modeled for anything extra other than the historical growth rate? Like if it was historical growth rate of, let's say, 5%, is that what you've used to model the future non-interest income, or have you added something else to factor it into that growth of that non-interest income? So what is it made up of, and what have you factored into the growth rate for net interest income?
Okay, as I explained, we assumed the growth rate to be growing at the rate it has been growing historically. So we expect it to project itself in the future. And then earlier,
it's actually reducing. It's actually reducing if you check that graph properly. So
which
that's
one?
why I was asking.
The net interest.
Net interest income. So the bar compared to the bar related to interest income, that growth is
the first
less.
graph or the second graph?
Second one.
This one?
Yes. So now maybe you can give insight on the makeup of that non-interest income so that you can understand what is growing it.
Okay, which graph do you want clarification on? This one?
Yes, that one, the bars.
Okay, the bars.
Yes. What makes up non-interest income and what's factoring into its growth? Yeah.
Okay, non-interest income typically implies the revenue generated from non-interest bearing assets, probably, yeah. Income from non-interest generating assets. So CRDB has expanded its, probably, we can, in the revenue segmentation of CRDB, we indicated that it generates some of its income from insurance brokerage. So insurance brokerage is one of the revenue segments that generates a substantial amount of CRDB's, non-interest revenue.
Do they maybe hold like bonds, bills, any kind of like fixed income that would generate for them interest on that non-interest income? Is there anything like that?
Okay, CRDB holds treasury bonds. Yeah. And then I wanted to include some clarity on the declining blue line indicating the year-over-year growth in the income. So I said that the green line indicates the actual income itself, but the blue line is the year-over-year growth. So a question was posed why is it declining? So I think I can answer that by this one. As we had previously stated, CRDB is diversifying in new markets, especially in Burundi and CRDB. Therefore, the operational expenses of CRDB have increased due to such. So that's the reason of the decline in the growth rate, but there's still a positive because the bars are still increasing due to the increase of the actual income. So probably the decline in the rate might be due to some few incremental costs due to new investments in the DRC and Burundi, but overall the income is expected to continue growing.
So do you feel that after they have settled into the new markets, the growth will go back to rising? And why?
One thing why we projected that it's going to grow, we made the assumption in any company, any growth is determined by the growth of a nation. So in Eastern Africa and also in Tanzania, we projected that the growth is going to grow up. So alongside with it, you see CRDB is well known a brand, so it is going to utilize on that so that it can grow as well with the growing economy. Yes, and other things that maybe caused those decline is changes or shocks in the market which can cause things to drop, like government policies and things like to do with change in interest rates of the competitors.
I can add on whatever you said. Considering World Bank recent analysis forecasted a growth of 6% in the Tanzania's economy, and CRDB being a leading bank in Tanzania, there's a chance of growth.
So to summarize on that, typically for any new investment, firms usually have negative cash flows. So the funds that have been put into the investment into the new markets, we expect to CRDB, as any other firm that experiences negative cash flow during an initial investment, to recover the cost and then continue growing. Yeah.
Let's give Team E a round of applause. Next, we'll be having Team A on stage. We'll give the judges a minute to complete their scoring. Team A, let's have you come on stage. All right, Team A, your time starts now. All the best.
Good afternoon. And now we'll be looking at the future outlook of CRDB Bank.
As part of their futuristic strategy, CRDB is currently collaborating with TIB in order to focus on both infrastructure and trade. This is out of the norm for CRDB Bank because it majorly focuses on agriculture and mining.
Looking at the at the market outlook of CRDB Bank, as you can see, the market share of total assets is still high. It's 24%, which is closely followed by NMB Bank. But then now, what differentiates CRDB Bank from NMB? We expect that market share of total assets to go up as by 2026 because the CRDB has a strategy to venture into countries like Malawi, Comoros, Zambia, Zimbabwe, which is in line with the evolved strategy, third pillar of sustainability and growth. To add on to this, I would like to highlight that as for now, NMB Bank doesn't have any plans or strategies to move into the regional sector. To add on to this, for the DRC and Burundi strategy paper 2025, for the agricultural development, which requires the government to create partnership with the banking sector. And as we know, Burundi growth rate for the agricultural sector is 4.4%, and for DRC is 4.6%. But then, since CRDB is a strategic partner with the government, they're likely to take advantage of the growth. Now, looking at the internal and external factors that might impact CRDB, we expect CRDB to take opportunities like the growth in digital services as they are planning to broaden their digital infrastructure in the country. Additionally, they plan to expand their Islamic banking, Al-Mubarak, to reach the 35% of the Islamic population.
As part of the challenges that they are likely to face, CRDB Bank is likely to face market competition. Following M-Pesa, which is a digital app, we are saying that CRDB is likely to face stiff competition, and therefore it requires of them to improve drastically. The second one being regulatory risks. So as you are being told by my colleague here, that Islamic banks have come up, and it was established in the year 2021, but these Sharia laws are extremely strict. Therefore, this poses as a challenge. The next one is on geopolitical uncertainty. Following the political apprehensions that are happening in DRC Congo, there may not be much that CRDB could possibly do. However, they do have plans to venturing into the southern part of Africa, which is Comoros, Zambia, and Zimbabwe. Now, the next thing I shall be taking you through is the risk matrix. What are they likely to be facing? One of them being credit risk. That is the ability or the probability of customers defaulting in terms of their payments. So the credit risk is low, as you've been told. The non-performing loans are at 2.8%. What have they done in order to reduce the non-performing loans? One of them is robust credit assessment. This enables or ensures that whoever is taking the loan is actually credit worthy. The second one being diversification of the loan portfolio. This helps in reducing of unsystematic risk. Then we also have the market risk, which influences currency valuation. So what they have done in order to mitigate this risk is focus on FX hedging tools, options, and swaps, which are derivative instruments that ensure stability in their currency.
Looking at the ESG analysis, in terms of governance, the bank still plans to maintain a hybrid structure in their governance, and they look to maintain a high retention of their employees so as to maintain their standards of living. And for any provisions for new employees, they plan to accommodate them in the expansion of the bank. Environmentally, they plan to reduce green carbon emissions by 10% by 2030, as well as engage in renewable energy sourcing and increase this by 20% by 2030. And how do they plan to do this? They plan to do this through green funding and partnership with Green Climate Fund. Then in terms of the social involvement, with the Women Empowerment Fund that they run, that they have achieved a 1 billion Tanzanian shillings by 2023, and they look to increase this portfolio to 3 billion Tanzanian shillings by 2030. They're also key to financing women-owned SMEs, and for the youth literacy and employment program, they plan to use this to reduce unemployment in Tanzania, as well as funding SMEs so as to conduct trainings for the citizens of Tanzania.
Moving on to what we did under the technical analysis of the share prices. So what we did is that given that these indicators are historical, therefore we relied on the Black-Scholes models and the geometric Brownian motion, which informed us that the probability that in the next 52 weeks that the share price shall actually reach 1800 as per our earlier valuation is at 69%. Then we also wanted to evaluate what would be the chance that the prices actually cross the 1,000 Tanzanian shillings mark, and we found that that probability was at 78.72%. Okay, moving on. So part of the momentum indicator here was showing us a region of price consolidation. And one thing to note is that given that currently the CRDB shares are highly undervalued, we expect that there's going to be a high buying pressure in the near future, which is likely to push the relative strength index above the 70% mark. This will mean that there's going to be a likelihood that prices will begin to correct and consolidate, which means that moving on to the future, we expect that the growth rate of the share prices to actually slow down.
Then in terms of their financials, with a 95% confidence interval, the non-performing loans are expected to remain within the following bounds: an upper bound of 320 million and a lower bound of 140 million. And this will help them maintain the range of 2.9 to 3.6% non-performing loans over the next 5 years. What does this mean for the bank? It means that they'll be consistent with their strategy implementation. In terms of their asset quality, they expect to remain at 1.8% for the next 5 years, and for the profit after tax, they expect to continue to grow by 25% after adjusting for inflation for the next 5 years, and then to slowly go down to 20% dependent on their expansion to Zambia.
Looking on to the projections for some of these metrics as per their financials, we expect that the revenue growth rates shall remain a bit earlier we had found that the average growth rate was at 29.7%, but we expect this to slow down over the next 5 years to 25% and then slowing down eventually to 10% by 2028. We also expect that the total assets will increase by 7% within the next 5 years, and we expect that the return in equity to remain within an error margin of 2% from the current 26%. Additionally, we would like to Additionally, we'd like to speak about the residual income. So as part of the residual income, some of the key things to note is that we expect that if they do take up capital projects in the countries that they're expanding into, that is Zambia, the Comoros, and the Malawi, we expect that actually the projections that we had before might face a slight drop because they might have to do more capital expenditures. Then additionally, just still on the residual income, we expect that the total shareholder fund will increase, which means that that will also affect the cost of equity, bumping it up to a cumulative of 9.4%. That will mean that for the residual income, it may give us an indicator that there may be a slowdown in shareholder value creation. Last but not least, because of the expected buying pressure that shall be on the shares, and also the expected future earnings, we expect that the current PE value, which is currently at 2.8 compared to the industrial average of 9.8 as per the Ernst & Young report of 2024, we expect that that value will actually go up, which means that eventually we shall have the shares not being deeply undervalued as of 2027. With that, we would like to bring a close to our presentation and welcome the questions. Thank you.
On
the credit risk, you have mentioned that the likelihood is medium and the impact is low. What are they doing to make sure that when the risk occurs, the impact is low?
So one of the strategies they've employed is just rigorous credit assessment. So they ask questions, and if it's a securitized type of loan, they do ask for mortgage. So in that way, they ensure that should they default in payment, they do have a mortgage to back it up.
Please allow me to add on to that. So notably, one of the differentiating factors for the loan products for the CRDB Bank is that they have been consistently able to maintain a 1.5 to 2.3% lower interest rate charged on loan facilities, which means that it's actually more attractive and also cheaper, considering that this is going to be compounded over the years for people to actually acquire loans. Then they also do financial literacy programs to assess those who are seeking their loan facilities, which enables them to actually categorize those who at the end of the program will be qualified or deemed qualified to access the loan facilities.
Thank you for your presentation. There's a slide you had for moving averages. In that slide, your moving average, you guys can hear me, the moving average for the 100-day and the 200-day are both declining. But you're projecting that things are going to increase. So I wanted you guys to give me insight on that. Are you seeing there? Your average closing price is bullish, but your average 50-day and 200-day moving averages are both declining.
Okay, allow me to begin with the simple moving averages. As a lag measure, one of the things that we realized is that the simple moving average has two big limitations. One, it does not consider the trade volumes, which means that this is not going to capture the volume, the daily transactions in terms, or the weekly transactions in terms of the acquisition and disposal of shares of this bank. So that's one of the limitations of the simple moving averages, which is the reason why we included a momentum indicator. Then another thing to note is that which is also the second limitation of using the moving average, which is also another reason why we used the relative strength index, is that when you use the simple moving average, it being a lag measure, it adjusts slower to the economic conditions of the particular sector that you are evaluating.
I was doing some research at lunchtime, and I found that there was a survey in 2023 by a company called FinScope. And the information therein is that only 22% of the adults in Tanzania have access to the traditional banking services. Is it therefore prudent for CRDB to be venturing out to other countries like Comoros, Zambia, yet they haven't saturated their home market? What are your thoughts?
So I think they should still expand into the other countries that they plan to venture in, because as much as that's what they plan to do, they still focus within the country to cover the unbanked, and this is mostly through their digital banking, and this is to try make banking accessible to people, like because using digital banking you can reach a wider range of people compared to the traditional banking system. So I think that's still work that they're trying to do. Yeah.
Allow me just to add a single statement onto that. So as part of their evolved strategy, the first pillar is retail customer services, and as we had seen earlier in our presentation, that currently they have up to 34,000 plus agents who are working and over 2,000 points of sale. So the goal that they actually have to do is to increase this to reach the unbanked population. So looking at the most recent report that we checked as a team, that was their Q3 investment report, they only gave an estimate of increasing that by 15% annually. So that was the most we were able to get from the investment report.
Thanks for that. So you're expecting the share price to go up 3 times from where it is? That's what your target price is?
Yes.
What are the time frames? If I'm to invest today, when would you advise me that I will realize this 3 times return?
Maybe I can add to that question as well. There's somewhere where you had indicated that you have a 78.2% probability of having a 1,000 plus share price. What is the basis of that 78.2%? Because it relates to what he's asking.
To start us off, yes, we expect the share price to grow because as you can see from last week's share prices, the stock was trading at 660, but then by Friday, the stock went up by about 5% to 690. So I'll just allow my colleagues to answer to that.
In addition to that, what we realize is that if the movement of the share prices, because we actually did a simulation on the stock prices, we realized that if they do maintain a drift of 5%, then that should actually ideally be able to reach that valuation within a 52-week period. However, this was only if we assess it based on the multiples approach, which gave us the most practical outlook on the investor sentiment. This is one of the reasons why we gave this a heavy weighting is because we were looking at an alternative of looking at, for example, the asset pricing model, the APT model. And what we realized is that different factor loadings that affect that affect the banking sector, specifically the CRDB Bank, the data on the private side was not accessible, but on the public channels it was accessible. And from the public channels that were accessible, what we realized is that, I'll speak of 2 loading factors, if that's okay. Okay, sorry.
So you're saying 5%, if it grows by 5% every week, then in 1 year's time, the stock price will be up 3 times. Did I get that right?
Okay, like I had said earlier, it will be 3 times with a probability of 69%.
That's fine, but it needs to grow at 5% every week for 3 times.
We don't expect the 5% to be like a constant weekly growth rate.
Okay, indicatively. So what rate are you expecting the company's profitability to grow by? Is it going to grow at 5% every week also? Or?
No, like I had earlier mentioned, when I was speaking about the projections for the company revenue growth rate, for the past 5 years, it was evaluated to be at 29.7%. However, from our projections, we saw that it is expected to improve at 20% for the next 3 years and then slow down to 10 to 15%.
So those are annual changes. So you're saying the stock price is going to grow by 3 times in 1 year, but the company's profit is only grow by 20% in this same 1 year. Does this sound like a reasonable investment to make if the company's profit is 20% in 1 year, yet its stock price is going to grow by 3 times? Does that sound like a sound investment?
And maybe to add there, that should be reflected in the price to earnings as well. So those 2 things are supposed to be speaking the same language. Yeah.
Okay, so in all honesty, we only looked at it from we only looked at what will happen with the price to earnings ratio, and from the earlier valuation that we had given of 1,800, which is almost 3 times. Realistic, if you look at it from a more realistic perspective, leaving aside the probability, it may not actually get to that 1,800 if we are just being honest to our valuation.
What's your honest evaluation then?
Okay, what I had meant is this. Our valuation was 1,800, yes. But what you're saying is that Okay, just to sum up what we realized about or something that we know about all models. In finance, we say all models are wrong, but some are useful. So this was basically what we found based on comparing it to peer companies within the region. So the only way we could say that this share price could possibly reach that value is if their current strategy of expanding into Zambia actually succeeds. Because they don't do greenfield financing when they move into a new company, they do acquisitions.
Thank you, guys. That was a good job.
Round of applause for Team A. Now we'll have our final team for the second round, Team G, coming up on stage. We'll give the judges a minute to conclude their scoring and have the final team of round 2 present. All right, Team G, your time starts now.
This is Team G. My name is Anne Gigi.
My name is Onserio Stephen.
My name is Beth Morgan.
My name is Nelly Kendi.
According to IMF, the Tanzanian economic outlooks remain positive, and there is a steady growth in the banking industry. According to Moody's, the creditworthiness has improved from B2 to B1. The inflation rate of Tanzanian economy has also decreased. With this will help the banking industry to make more profit, to be profitable, as more will be able to lend out. According to CRDB, their market position, we project that they will maintain their market position as being their leader with 27% market share, simply because of their regional expansion, which has gone to Congo and Burundi, and also their solid balance sheet, which serves as a strong foundation for sustainable growth and dominant market presence.
So we forecasted gross loans to increase at 15.9% CAGR between financial year 24 estimated to financial year 27, based on first the economic factors of the Tanzanian industry. So looking at the Moody's rating of Tanzanian economy, as we have been informed by Anne, we see an improvement first in the creditworthiness of the people who are receiving loans from CRDB Bank. Therefore, we can see that from the improvement in creditworthiness, the bank is more willing, in our view, to lend out more loans, since this depicts a decrease in the risk in the default rates by the people in the Tanzanian economy. Therefore, in our view, one of the factors in which we figured into the growth in loans is the improving creditworthiness of the borrowers in the Tanzanian economy. As we've also seen from the projections of the Tanzanian economy has been growing at a rate of 7%. We also assumed that our growth will be in line. In our forecast for the loan growth, we factored in the financial inclusion initiatives by CRDB Bank. First of all, we see the launch of the Al Baraka banking segment. The Al Baraka banking segment is a Sharia-compliant financing, and this is a market segment that had been left out for a while. And we, as witnessed from our analysis of Al Baraka banking segment introduced by CRDB Bank, which also offers products across retail, the retail segment and the corporate segment, we see a positive improvement for financial year 2022 to 2023, and an increase in the customer deposits. Therefore, the bank will have more in capital to lend out. So now, our growth in loans. Now, next, we looked into our fluctuations in the net interest margins. So we forecasted a positive fluctuation of net interest margins from 7.9% to 8.4% financial year 2027. So the positive fluctuation in net interest margins will be brought about by an increase in net interest income, which we forecast to grow at 16.7%. And the main contributor, the historical main contributor of net interest margins for CRDB Bank has been the loan growth, which we forecasted a loan book growth So we forecasted a loan book growth of 15.9%. So with our forecast for an improvement in the loans, so therefore, as we've seen, loans, the growth in the loan book has been the main contributor for growth in net interest margins. Therefore, our forecast in loan growth goes hand in hand with our forecast in increase in net interest income for the bank, therefore leading to a higher net interest margin based for our forecast for financial year 2024 to 2027. So my colleague will take you through cost efficiencies for the bank.
It is something interesting that the CRDB Bank cost-to-income ratio have been declining between the financial year 2019 to financial year 2023 to 15.3%, which is still above the minimum threshold of 12%, hence more capital surplus for the bank. And also, in the cost efficiency for the bank, we project the positive trend is brought about by the growth in the income for the bank, whereby the growth is 14% CAGR, or outpacing the operating expense at 7% CAGR. And also the operating expense is projected at 14% CAGR coming financial year 2027. And this brought about by the investment in the information technology and also the growth in the asset for staff asset. Coming down to the NPL ratio, we realized that the NPL ratio for the bank declined previously from financial year 2016 at a rate of 14% to a low of 2.5% financial year 2023. And we expect a fluctuation of 2.5% financial year 2024 to financial year 2027 to reach up to 3%. And that's all I had.
Under ESG, CRDB Bank being the first bank to be accredited by the Green Climate Fund, it secured $200 million, which they are used to finance the smallholder farmers, of which you assume they are their stock, that is their customers, that they are potential future customers, that will increase their stock and have, in future, they might be their customers. Their governance, they have specialized governance committee, which specializes on audit, on credit, and also in monitoring and advising on the key strategic future plans for the bank.
Back to our cost efficiency. From the historical performance, we see income growth growing at 14% CAGR, outpacing the growth in operating expenses. So in our view, this suggests the management's efficiency in cutting off their costs, which is now in conclusion of our factors in which we considered for growth in CRDB Bank. First is the management's efficiency as depicted by growth in income outpacing growth in expenses. Secondly, we factored in the improving economic conditions as highlighted by Anne and an improving credit worthiness by the bank. Thirdly, the financial inclusion initiatives, as you mentioned, by Al Baraka banking segment. And also, from what we've seen from the industry, we've seen that 19% of Tanzanian population is financially excluded. And the majority of this population comprises of youth and women. Therefore, CRDB Bank has launched the Mbeju program, which is mainly set out to support the women and the youth. Therefore, we view CRDB's financial inclusion initiatives will ultimately lead to the growth of the bank. Thank you.
In conclusion, we strongly recommend a buy recommendation or a buy rating for CRDB, for we are confident in its ability to deliver substantial returns for an investor. Thank you.
Thank you for the presentation. My question is on the leadership position of the bank. How does CRDB intend to maintain its position, its leadership position in the market?
Number one is through the regional expansion. As we have seen right now, we have CRDB in Rwanda, CRDB in Burundi, and CRDB in Congo. And in Tanzania, CRDB has covered 76% in the financial market. That's meaning that it has covered a higher percentage of, or it has reached a higher percentage of people in Tanzania. But still, with its distribution model, having the banking sector, having the ATMs, having the SIM banking and also the online banking also, it will be able to reach more people, and hence it can be able to sustain its market presence. Number two is solid balance sheet. When you look at the CRDB balance sheet, it has a solid balance sheet on return on assets. This gives them or serves as a strong foundation for its growth to be sustained and for it to remain dominant in the market presence. Thank you.
Thank you for the presentation. From all the factors you're putting forward, it seems that CRDB is really doing well. Is there a room for improvement? And if yes, how?
So from our analysis, we saw that its competitor NMB Bank is the leading bank in terms of customer deposits. Therefore, CRDB Bank as the second bank in terms of customer deposits, their financial inclusion initiatives indicate to us that they still need to improve in terms of their position in terms of customer deposits. And secondly, CRDB has a high LDR. The liquidity to deposit ratio is quite high. From our last estimate, it was at 96.7%. So from the historical funding mix for the bank has mainly been funding its operations through customer deposits. Therefore, we've seen the bank as it has a high LDR, the bank needs to reduce funding from its customer deposits and rely on borrowings to improve its LDR, which is at a higher level of risk for the bank. So these are the areas we've seen that the bank needs to improve on. And number 3, in terms of cost efficiency, its competitor, NMB, has a cost-to-income ratio of 36%. For CRDB, it's 49.6%. So in this area, we also believe that CRDB needs to improve its cost efficiency.
Kindly elaborate on the LDR.
On the LDR, loans have been rising at a higher rate than deposits. So we see that loans, the LDR ratio has risen from 60. So we can see that the LDR has increased from 63.9% in financial year 19 to 96.7% in financial year 2023. To us, this suggests an assertive management by CRDB Bank. Although the strategy is highly profitable for the bank, it's still at a risk of default since the loans are trending more higher than the deposits.
There's a slide you had for net income margin. If you could go back to that slide first. Okay. Your projections for the last 2 years, I'm assuming that is 2026 and 27. The net interest margin is stagnant. I think that straight line up there. What's going on with that? The net interest margin line, it's not showing a growth year on year on your projections. Yet you've said that there's going to be a growth that is increasing year on year, with the exception of the reductions due to capex that you've mentioned.
The constant growth rate from our projections. Because because it's from the projections. So when you look at the projection, why it's remaining constant at a growth rate of in a back year for constant. So that's the reason we need
Tulilizana last year tukuwaipata jibu na tukuuliza because ni 3 years constant 8.4%.
8.4% for 3 years. So from our analysis, with the launch of the Al Baraka banking segment, this to us indicates a high growth phase for the bank. So for the initial years, we expect that the bank will transition to a stable growth phase.
Could you show us the slide for CAPEM? Because I didn't see you guys showing us the valuation slide. And ESG. But just show me the slide for CAPEM. Yeah. Gosh, I can't even see. Are you seeing there the cost of equity? You've put it at 19%.
Yeah.
I wanted you to just take us through these metrics because they're not supporting what you said. They're very aggressive.
Can you elaborate more on the question?
You've mentioned that there's going to be a lot of growth and there's going to be a growth phase, right? So this valuation model is giving a target price of 14.27, and that's being driven a lot by what you've included in the CAPM. So that's what I'm asking. What is the justification for the CAPM, and especially the cost of equity, which you put at 19%, if I can see right?
Yeah. So, we employed the capital asset pricing model to come up with our cost of equity of 19%. So the risk-free rate is 13%. The 13% represents the yield on a 10-year Tanzanian government bond. Then our market risk premium was 5%. We derived our 5% as we considered Moody's rating and default spread as part of our overall assessment of market risk. Then we assumed a market risk premium of 5%. And our beta was 1.0, which to us is an implication that CRDB's stock price will be moving consistent with the overall market movement. Therefore, from our forecast in growth, then we now derived our target price of 14.27.
Thank you, guys.
All right. Round of applause for Team G. So at this moment in time, we will tally the scoring from the 4 teams. We can take a short tea break. There's tea, 4 o'clock tea at 4:30. And then we'll announce the final 2 teams. Thank you so much, and all the best. To be a bit different. So the judges feel they have asked enough questions. You have gone through all the slides twice. Okay? So this final round will each give you 5 minutes. You will not use your slides. Okay? You need to convince the judges. These are investors now. So 5-minute pitch. Why we should buy CRDB. No slides, 5-minute monologue. There'll be no Q&A. So convince the investors in front of you why they should buy the CRDB stock. So in no particular order, the 2 teams that will proceed to the final round, Team B. Round of applause for Team B. And Team A. Round of applause for Team A. So we will start with Team A. Convince the investors why they should buy the CRDB stock. 5 minutes. So we need you back on stage now. Thank you. Team A? We need you on stage. 5 minutes, no Q&A.
I still time them.
Yeah, time and then 1 minute warning.
Time, then 1 minute.
That they're planning to expand regionally to countries, to South African countries like Zimbabwe. So that will enable them to expand their revenue streams and not only and reduce their reliance on the Tanzanian market.
Looking at their financials, they have outstanding financial performance and they're a key market leader with high returns on equity and high returns on assets, as well as the cost to income ratio has been declining over the years. So using this financial metrics, we think that in the future, the bank will maintain this good performance and continue to hold a bigger market share with its expansion into different regions within the sub-Saharan.
They do include financial inclusivity where they focus on Islamic banking. Although there is Sharia compliance which is strict, we do see their effort in terms of expanding into regions such as Burundi where they have 56% of people who are Muslims, which is so important. So they do cater to Islamic banking.
A key question that you might ask yourself as an investor is, okay, we've seen the financials, we've seen the numbers, but why? So that brings us to one important thing, that is investor confidence. We need to ask ourselves, when they project this kind of performance, will they deliver? So over the past 5 years, based on our analysis, we have seen that there hasn't been a significant deviation between what the strategy stipulates, what the targets are, and what they actually deliver by the close of the year. This means that not only is their strategy creation sound, but also the delivery is impactful and implemented with great care. Another thing to notice that if we look at the top level management, these are highly experienced people with an average of 15 to 29 years. That means that these are professionals who have the professional intuition to know what markets to go to and how to implement these strategies. Looking at what their past behavior has been when making acquisitions, for example, for the DRC Congo, they acquired 56% controlling interest. Therefore, they only need to acquire a minimum of 35 or 40% non-controlling interest, either in the FNB Bank of Zambia or any other major bank in Zambia, and that will highly increase their market share. That's one of the greatest reasons as to why we have confidence in their growth potential. This is a bank demonstrating the growth of wings. Get on board. The bullet train leaves now. Thank you.
Thank you.
Thank you, Team A. Lastly, we'll have Team B. Team B. Team B. Team B, please come on stage. 5 minutes. Your time starts now.
Ladies and gentlemen, CRDB's aim as the bank that listens to the people is very clear, that they would like to give great social economic value to all their stakeholders. We've looked into their business overview. We've seen their current evolved strategy is working, with subsidiaries giving them a profit increase of up to 46%. We've also looked into their industry analysis, and we've seen that the banking and finance sector in Tanzania is also growing.
Sustainability is no longer an option. It's the future of banking. And whether or not you would like to lead with the rest of CRDB in ensuring that sustainability grows is up to you. If you would like to be a follower of global development, then you're not going to get far. However, at CRDB, we can guarantee that you would be pioneers in a world that's inching closer and closer to sustainability. The market believed in us when they oversubscribed to with 429.6% in our Kijani bonds, so why won't you?
CRDB Bank, as we earlier mentioned, offers a compelling investment opportunity to investors. Our valuation methods focuses on putting the investor first, and they focus on capturing the long-term horizon of equity investors. And that is why we as Team B stand here today to strongly issue a buy recommendation at a target price of 836.1. Thank you.
Thank you.
All right. Thank you, Team B. At this moment in time, I'd like to introduce a very special guest. The research challenge, like mentioned earlier, has gone over 10 years now. This is almost our 10th year of the research challenge, and we cannot do it by ourselves. We rely a lot on sponsorship because we are non-for-profit. And at this particular time, we are honored to have Mr. Anthony Mwitega, who's the Managing Director of All Mutual Investment Group, which is a key sponsor for today's event. So we'll have a few words from him and then proceed with the program. Welcome, Anthony. Round of applause.
What am I supposed to say? Good evening. Good evening again. So my name is Anthony. I work at All Mutual, and it's a pleasure to join you this late afternoon for your ongoing 2025 Research Challenge. The little I've listened to, I've realized that the future of asset management is bright, or the future of investment management is very bright, because very talented young people like yourselves are talking about the things I used to hear over 20 years ago, trying to value a stock and convince investors why it's a good opportunity. Of course, it's an honor for us at All Mutual to be part of this activity or event today. Many of us in the office wanted to come to speak to you because there are so many CFA graduates back in the office who are excited to partner and work hand in hand with the society. And I congratulate the society leadership led by your board chair who is here for the work they continue to do for you. But this is why I came, apart from meeting all of you, is to see Joyce. I haven't seen Joyce for over 12 years. Many, many years ago, I used to work for her. And I'm happy to see that she's really putting a huge effort in bringing more investment professionals in the country and of course in the region. So for the participants for the day, congratulations. For those who've transgressed or have moved to other stages up to the last two I've seen groups, you're all winners and congratulations. One of the attributes of the investment management industry is it has a very strong barrier to entry for professionals like all of us. But one of the easiest way to eliminate or to reduce that barrier to entry as a professional or as a young student and a potential employee is by studying the CFA program. So all of you are steadily dealing with that barrier. And the people who work in the industry cannot be more than excited to have talented minds like yourselves. There are 4 attributes which you've learned in what makes you a good analyst or a good entry associate to the industry. One of them is you have to like it. So if you're studying the CFA program and you don't like the industry or the profession, think twice. So you have to like it, you have the passion for it. That makes you persevere. Secondly, you have to be extremely analytical. And the CFA course, and I know all of you are passing, is one of the hardest courses in the world. It's actually underrated by scientists, but they need to know it's as hard as any form of science in the world. And it produces very strong analytical individuals who are able to crack and analyze numbers on behalf of investors. Thirdly, it requires people who think beyond the ordinary. One of the things you'll do once you start doing this practically is, you must have read it in some of your CFA books. I've never done the program, but I've taught the program, is removing the accounting veil. That means you'll help people understand the financial statements beyond the accountants and auditors and make meaningful to them. And then fourthly, why this is very special and important for all of you is the program enables you to develop very early research skills. In normal academia, people become research analysts when they've done graduate programs, like PhD programs or 3rd degrees. Here you become an accomplished research analyst at the tender age of, are you guys what, 18 or 19 or 20? And that's a huge honor. I have a daughter who is 20, and she tells me before she retires, she's going to do the program. That means she'll not do it. And that's very sad for me. The last thing about this program is that it enables you build the necessary skills you need beyond normal finance in your own personal investing journeys. You'll get a chance to manage large pools of money, whether for retail investors, institutional investors, and otherwise. But you'll have an opportunity to manage your own money better. The assumption is it's the accountant, the banker, etc., who understand investments. But the people who understand investment is yourselves as potential CFA graduates and upcoming investment professionals. So all the best to all of you in your careers, both at university and at the CFA program, and all the best to the winners of the day. Asanteni sana.
Thank you so much, Anthony. Next, we'll be having Mr. Francis Nasyomba, who's the president of the board of CFA Society East Africa. and he will announce the results for the winner.
Good afternoon. My name is Francis Nasiomba. I'm a CFA charter holder, and I'm currently the president of the CFA Society East Africa. I know you don't want to hear from me apart from the results, so I'll make this brief. One, I'd like to just congratulate each of you. I got my CFA charter many eons ago. I don't want to say it so that you don't guess my age, but I've been in this journey for quite a while, and I want to appreciate the process that you guys have actually taken. We were sitting today with one of the judges, and I was telling them, at your age, I don't know if I could do it. Maybe we could, but you guys are doing it very well. And I was saying that sometimes when we judge, we need to be careful not to judge expecting what we can do now, because we've had a number of years of experience while we do it. The second thing I'd like to say is to encourage the participants, and this is not the typical speech of all of us are winners. It's actually to tell you that, as Richard had said, 70% of the people in the world have a phobia of speaking in public, right? Meaning you're one of the very many unique people, of the few unique people. In this current instant coffee world, where everybody wants to succeed today, yet no one wants to put in the effort, the advice I can give you is just try put in that slight extra effort. You'll be so shocked. You'll end up being a superstar more than anyone. I also want to acknowledge the universities that have announce the winner so that you do not stay in limbo. And the winner is Team B, Strathmore University, Team A. Have I confused you enough? The winner is the team that was named B, which is from Strathmore University, Team A. They don't seem as excited as I expected. So let's give them a round of applause, please. Congratulations. And I'd like to call our guest of honor to help in awarding. Joyce, maybe you can help with the logistics?
Yes. So we'd like to have the judges on stage, as well as Mr. Anthony Muthiga, to award the team. I don't know if the faculty advisor is here, industry mentor from Strathmore University.
Okay, to the winners, please join us. I believe you've had the courage to stand in front, so this should not be. And the judges also. Karibu. Yes, I'm being told should notice that it's an all ladies team. The Constitution of Kenya So the photographers, if you're done, we'll award for the So we'll give an award for the university, the school. I don't know, the captain can collect it. Or okay. So the judges come in.
Richard will award the industry mentor because they were paired with their industry mentor. Maybe you could mention his or her name. And congratulations in absentia.
Her name is Caroline Kirago, currently working at NMB Bank. Yes.
Congratulations. I have a message for you.
So on top of the very beautiful plaques and statues, we'll not forget your cash reward, $500 for the team. Let's give a round of applause.
Them say, them tell you say you can never be the one.
Congratulations, Team B.
Say, make I tell you say now you
round of applause for Team B.
In 1 month, unless I die, you will hear congratulations to the glory of God. Congratulations, He has done it for you, and you will come back with a new song to sing. God is good. Yes, you will come again with a new song of praise. God is good. Oh, congratulations. 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 See what the Lord has done for you. Congratulations. God is good. Them say that I can never be all that I see. I've seen God is greater than that. Who will come back with the Lord? Nobody who can change his mind alone. For many years, in many ways, I have said his faithfulness ever and ever. Congratulations, I have seen the glory of God. Congratulations, He has done it for me, and I have come back with a new song to sing. My God is good. Yes, I will come again with a new song of praise. My God is good.
To the runners-up, there's always the runners-up. There's a consolation prize for you. Would you like to collect it, or do you want me to keep it? A round of applause for them. Congratulations. They say in life you need to learn to celebrate someone else, so that we'll also celebrate.
I bring you good news where you cannot refuse.
Okay. So this officially concludes our event today. There is tea. Please don't leave without having some tea and snacks, having a few conversations, networking. Target the individuals that you feel you need to have a conversation with. But thank you all so much for this great event.
Everything you put your hand go walk. Your name go open doors. You self go be a boss. Amen. Amen. Everything you put your hand go walk. Your name go open doors. You self go be a boss. Amen. Amen. Every hustler getting paid. Where the hustle go come to pay. Your own in no go take. Amen. If you don't find work, do your own. God self go do his own. And flesh go cover bone. Amen. Amen. If you believe it, say amen. If you believe it, say amen. If you believe it, say amen. 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 Everything you put your hand go walk. Your name go open doors. You self go be a boss. Your name go open doors. You self go be a boss.